It has been a very thin rally. There are certain parts of the market that are doing well, others that continue to struggle.
It's remarkable the way that the economy has performed in the face of such rapid increases.
The consumer balance sheet overall is in good shape. Business balance sheet overall is in good shape.
There is still a lot of residual tension related to liquidity within the banking system.
You're in the transition period. We had 14 years of low interest rates, and the real impact on valuations, it takes a while to filter through.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures negative 0.6% on the S&P. Wrapping up bank earnings for the major players on Wall Street a little bit later this morning with Morgan Stanley in the next couple of hours. After the close, though, yesterday, a focus on the regionals. So let's focus on the regionals right now. Western Alliance in the pre-market up by 16% this morning. Zion's a little bit later after the close, then on to First Republic this coming Monday. Now, TK, we've got to talk about this. So far, so good for the regionals. Never mind the big players. Western Alliance yesterday reporting profit better than expected and deposits recovering slowly.
Synchrony Financial out moments ago with the same thing, John, leading with deposit information. I'm with you. It's a big deal, and you see it in the market this morning. We don't need to do the data check right now, but this is under the radar within the news zeitgeist. I agree with you. This is good news, calming news by the regional banks, and you see it cross-asset on the Bloomberg screen.
Lisa, Piper Sandler calling this one a significant win for this bank.
They had deposits down about 11%, but the stabilization, the growth over the past week or so, highlighting how perhaps the worst is over. Now goes the question of, okay, is the crisis over? Can we say that we've moved on? And if we've moved on, this goes back to the question you've been asking for the past couple of weeks. When do we go back to pre-March 8th conditions? We are almost there, but not in the bond market. We still have quite a ways to go.
To me, it's about a Fed that gets permission to come up 25 beeps. And again, you see that within the real rate. We'll go into the day. The two-year yield clearly indicative of that, John.
Then what? So you get the hike implied by the dot plot. Then what? So they were asking the question whether the banking stress of the last month was a substitute for rate hikes. They concluded to some extent it was going to be. We just didn't know to what extent. We're going to find out. Your two-year this morning by 7 or 8 basis points to 427. Tom, I think there are two ways of looking at this. One, the stress is stabilising. Maybe even the coast is clear. That's the super optimistic, constructive way of looking at things right now. The other way is this is the beginning of a process. Jim Zouter of Apollo talked about that will ultimately lead to tighter lending standards, tighter financial conditions, and remove some of the pressure from the Federal Reserve to do even more. And you've got to pick your poison. But ultimately, this bond market has repriced as we've shifted away from the worst-case scenarios, and we've taken a two-year from 350-something back towards 430.
Yeah, the breakout this morning at 4.27, a solid 7 basis point move, indicates that direction. You know, that one view there is on the edge of Bramo. And the answer is, Lisa, you mentioned this yesterday, there's a set of narratives out there now. It's not this or that, bull or bear. There's a whole wide set of stories out there. You can pick your story this morning.
I would pick the story of inflation. It's still a real problem. And I know that Britain is its own story, but the fact that it came in above expectations at a time when you see credit tensions easing in some of the biggest risk factors, the idea that something broke, well, maybe it didn't break. Okay, well, then do we have to go back to worrying about inflation again? Starts to really dominate the narrative in a way that perhaps people had forgotten about for a bit.
Double-digit CPI in the UK, sticky inflation over in Europe as well. The Eurozone has its own problems. A story crossing the Bloomberg in the last 10 minutes or so. Bit of breaking news on the Bank of Japan from the team here at Bloomberg. BOJ officials are wary of tweaking or scrapping their yield curve control at a policy meeting next week, so soon after the banking crisis overseas clouded the outlook. This according to people familiar with the matter, Tom, off the back of our reporting. Off the back of that, dollar yen coming back just a little bit. Still positive on the session by 0.5%. Dollar yen, Tom, 134.82.
Weaker yen, 132, 133, 134. First thing I did this morning was triangulate euro yen, and it's it's really buttressed right up against resistance, where a 148 or a 149 print would be a huge deal for euro yen. 147.38, and that's not so much euro dynamic as yen dynamic, and that comes just before that YCC headline.
Let's get you to the price action just briefly. The S&P 500 futures negative by 0.6% on the S&P. Yields higher by 4 basis points. Let's call it 362 on a 10-year. And in the FX market, just a touch of dollar strength here. Euro dollar, Lisa, back down to 109.33. We're negative there, 0.33%.
The main course today, as you were talking about earlier, bank earnings. Do we care about Morgan Stanley coming out around 7:30 a.m.? Or is it really going to be the focus on Citizens Financial, U.S. Bancorp? We're going to get all of those in the next couple of minutes here in the 6 a.m. hour. We get Signature Bank and Silvergate Capital at some point today, and then Zions Bancorp after the market. You pointed to what we got yesterday, given that Western Alliance performed much better than expected, the huge pop. If we get a consistent stream of that from the regionals, all of a sudden, is banking crisis over, and do we revert back to where we were before? At 2 p.m., we get the Fed Beige Book. I know that, Tom, you're going to be reading through the whole thing. I actually think this is going to be really telling at a time when you do see that Bloomberg U.S. Financial Conditions Index revert back to almost where it was before March 8th. Do we get a sense of the bifurcated nature of places like San Francisco versus, somewhere in the Midwest or a manufacturing hub in the South? And today, FedSpeak includes both polls of the Hawks and the Doves. Chicago Fed President Austin Goolsbee, who's emerged as something of a dove, 5:30 p.m., and New York Fed President John Williams at 7 p.m., whether they perhaps signal something in terms of a policy response.
Does the Beige Book get in the way of Bayern Munich, Manchester City? I think it does.
Not for me.
I think it's,
Might do for Lisa.
I can look into that.
A little bit later.
Definitely.
I'll say this about Goolsbee, just briefly. Fantastic speech last week, really interesting. Not because of what he said, just because of how he said it. I thought it was direct and easy to understand. He's talking about patience at the moment. I just wonder if that's reflected by him today, Tom, off the back of some of the data we've had. They've got time, ultimately, still early May, just to get a little bit more information from the regionals and gauge where we are. I just love the idea, and this comes back to 1907 and the formation of the Fed and the modernization of the Fed in 1951. All these presidents are different. And Goolsbee, I love the distance from Chicago to Cleveland, from Goolsbee to Mester. We are so fortunate to have those two within the banking system. Agreed. George Concalves joins us now to discuss, the head of US macro strategy at MUFG. George, I've asked this question a number of times, but I think we need to update the answer to it. When you look at the totality of the data, the traditional indicators, the latest on the banking situation, where do you think the Fed's going to come out on that?
I think they're going to be relieved that things have not gotten worse. I mean, their measures, as well as just the passage of time, has allowed for us to get a better sense of where we are in this process. But as you described in the open, I'm actually much more in the latter camp, in the sense that it's too soon to tell exactly if this is all done. I mean, we're seeing better earnings, and that's great to see, but this is going to be a process, I believe. George, I'm fascinated by, and you've always done this over the years, a more holistic view. If we get through these various worries, and with all that cash that's out there, is there a shortage of bills, notes, and bonds that will move price up and yield lower than we would guess? At some point, absolutely. I do think that's always been the case. A shortage of collateral has been a big driver of just the nature of the banking system, both the U.S. and globally. But before we get there, we're going to have to get through the debt ceiling, which throws a whole other monkey wrench into the situation.
Do you feel like at this point, George, if the Fed does hike another 25 basis points and holds it there, as they keep saying, even though the market disagrees, that more things will break in a way that people perhaps are not anticipating? Here's the thing. I mean, the Fed obviously can raise short rates to whatever level they want to get to. But the more they raise rates, then they're going to have to defend that position and stay on hold for even longer. So the more they hike, they're going to have to try to at least maintain their position, because why cut 2 months, 3 months later, right? So I think it does cause a challenge for them, because I do think the data will get weaker into the summer and into the fall. And so they're going to be faced with defending why they raised to begin with these last few hikes, as well as staying on hold at 5+%, which could then start to expose further weaknesses. Like, we got to remember, like, what got us into this issue to begin with was higher rates. The longer you keep them there, it's going to expose other fragilities. This is the reason why perhaps central bankers are really concerned about the potential banking crisis, whereas certain aspects of the markets have moved on. How much has it been fully priced out of the market that there is some sort of banking crisis or credit crunch that could come down the pike?
Look, I mean, I think the way you put it was, I mean, there's a bifurcation among a lot of different measures, both between the financial economy versus the real economy, which the real economy is much more aligned with these regional banks and small businesses, and they're expressing concern about getting access to credit. So the fact that you're having that, and we've had tightening standards all throughout this period, I think it's again too soon to tell where we are in this stage. But I do believe, the markets are also sending mixed signals as well. I mean, you still have the overall Treasury curve well under Fed funds. So the bond market does not believe the Fed's ability to keep rates high.
Yields have backed up in the last week or so, George. We have repriced the front end of the curve. Do you still retain a bias towards lower yields in the Treasury market at the moment?
We're coming up to some very interesting levels. Somewhere, the 10-year now between 360 and 370. The 2-year note, now meaningfully above 4%. I think if we made a move above 430, 440, I think that's going to be the real true sign if there's demand there. And if we rally right back, then I think that the markets are telling us that we've probably seen the highs in rates, at least on the yield curve.
Yields backing up this morning. George, thanks for jumping in, as always. George Concavas there of MUFG. Yields backing up by 8 basis points, just south of 430 on a 2-year. On a 10-year yield this morning, up by 5 basis points, in and around 363. I think that's the decision we've all sort of got to make. A range of scenarios here. One was the banking situation of the last month, an event we can leave in the past. Or two, was it the beginning of a process, Lisa, that will continue and we'll have to keep an eye on over the coming months and quarters?
It seems like people believe it's a process. How to play that out through markets, though, is different depending on the person as well. I was struck by what BlackRock had to say about the 60-40 portfolio, BlackRock Investment Institute, and the team over there, basically saying it's not going to work and you have to be much more stock-specific. This isn't a market set up for stock-specific type of investing. We have gotten completely obsessed with indexing and sort of broad themes and the beta of what's going on with the Fed. How do you transition to something more old-fashioned?
Well, we can talk about single names. Job cuts, Tom, coming to Meta, to the Walt Disney Company.
Yeah.
Another price cut from Tesla on one specific model. Another one. I think that's the second one in like the last month or something.
I don't
TK.
get that.
That's a struggle to keep up with.
My amateur take is, good morning, Mr. Musk. I know you watch all the time. You do it repeatedly. It's called brand destruction.
Do you really think so? Why?
In the minds of the look, every business, the Bloomberg Terminal folks, is built on this, is the repeat purchaser. Every Tesla is a repeat purchase, and you're telling them the car they bought, they got screwed on, and it's priced less now. That's a core part of that equation.
Tesla negative right now by around about 2.5%. We'll pick up on that story a little bit later. Live from New York City this morning. Good morning to you all. Equity futures a bit softer here to kick off today. In about an hour or so, we'll get numbers from Morgan Stanley to wrap up the big banks on Wall Street. Then again later, the focus turns to the regionals. Equity futures down 0.6%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Republicans will vote next week on a bill to raise the debt limit and impose new cuts to government spending. President Biden and other Democratic leaders are refusing to offer any concessions. Republicans are betting that if the House passes the bill, that can ramp up pressure on Democrats to consider compromises. The debt ceiling has to be raised or the U.S. runs a risk of a default. Another strong inflation reading is raising the likelihood for more interest rate hikes at the Bank of England. Britain's Consumer Prices Index rose 10.1% in March from a year ago, driven by the strongest increase in food prices in more than 4 decades. The pound edged higher and UK government bonds sank after that report. Senior Russian officials have raised concerns that the war in Ukraine has left Moscow too reliant on Chinese technology. That's after U.S. and EU sanctions shut off access to alternative suppliers. An internal Russian memo suggests that Moscow is concerned that Chinese technology may pose a risk to Russia's information security. Fox News has avoided a potentially embarrassing trial. The network agreed to pay $787.5 million to settle a voting machine maker's defamation lawsuit over its 2020 election broadcasts. The settlement was less than half what Dominion had asked for, but was far above some analyst estimates. Fox had aired bogus claims that Dominion rigged the vote against Donald Trump. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
digital world has really changed the banking market. We're in an evolving market in the States. What was a deposit liquidity crisis is now a evolution of their business model, and really it's going to be a period of tougher financial conditions.
Jim, I got to make some news this morning. I'm looking for a Western Alliance transaction. Would you like to break that news here this morning?
I'll let others talk about that one. I got my hands full.
The brilliant Jim Zauter there joining us yesterday, the co-president at Apollo Asset Management, live from New York City this morning. Good morning to you all and welcome to the program. A little bit later this morning, earnings from Morgan Stanley. Got to reflect on some of the regionals so far. We mentioned just there Western Alliance. In the pre-market, that stock is up by about 15%. I'm going to whip through some of the price action more broadly for you on the S&P 500. Futures a little softer to kick off today. To kickstart today, we're down about 0.6%. Yields are bleeding higher again by 5 or 6 basis points on a 10-year to 363.29, and on a 2-year up 8 or 9 basis points, just short of 430. But that repricing is real on a 2-year. We're repricing yields higher.
I agree. It's a big move, John, and it's not something to look away from, with inversion from 60 basis points out to 65, and the real yield, which we've hardly talked about, out to a 133. These is, it's a boring Wednesday. No, it's not. There's actually a lot going on.
Just to describe the journey, the 2-year, March 8th, Lisa mentioned that date a little bit earlier on in the last 20 minutes or so. March 8th, the day before SVB started to blow up, the day after Chairman Powell opened the door potentially to a 50 basis point rate hike. The 2-year north of 5%, dropped to about 350 towards the end of March. And Tom, it's repriced from there back towards about 430. I just wonder how much weight we put on the traditional economic indicators again, away from some of the banking stress of the last month. But to Jim Zauter's point, I keep returning back to that question. One-off event we can leave in the past, or the beginning of a process? Jim Zauter talks about the latter, the financial conditions to tighten still to come, Tom.
Yeah, and you see it on the screen again, and our guest here right now is going to say the same thing, that you're seeing financial conditions tighten. We keep score of what people do, and a major theme for Charles Peabody of Portales Partners many years ago was get out of the way, the banks will survive, and they will have ample use of cash to raise dividends, buy back shares. And we still see what he predicted in the advance of the banks out of the crisis of 2008, 2009. Joining us this morning, Charles Peabody of Portales Partners. Charles, what I love is your price to book value relative valuation study. And what you're saying is Morgan Stanley, are they out today, John? Help me, I forget.
A little bit later this morning.
Morgan Stanley out today. and the others, and maybe those fancy banks will come into a price to book closer to the more traditional banks. When are we going to see that?
Well, good morning. Thank you for having me. I think the next 12 to 24 months is going to test the franchise of Morgan Stanley as it's been transformed. And before I get going on that, let me just say, kudos to James Gorman. He's done a magnificent job of transforming this franchise and adding ballast with the development of the wealth management and asset management businesses. But so far, this franchise has not been tested in a down cycle. And I think that's what you're going to see over the next 12 to 24 months. And right now, the stock is being priced as if a 20% ROTCE is sustainable. And I just don't think that's going to be the case over the next 12 months.
Within that caution, Charles, what is your single best buy right now within the major banks?
Citigroup, by far. I think it's going to prove to be contra-cyclical in terms of the stock price. And I think you're going to get a re-rating upwards in that big discount to tangible book over the next 12 months as they show that the integrity of their balance sheet is real.
Charles, we're talking about some of the biggest banks and how much more profitable they can be. We're not talking about the potential viability of regional banks, especially given the new model with a 5% rate on cash, which really changes the math in terms of what it will take for them to turn profits. Do you think that so far we have learned that that model is not dead, disproving some of the naysayers?
Well, I think time will show actually it is a problem. I mean, we've got a mini S&L crisis going on in the middle of balance sheets here in the United States. Tom will remember the old Bank America, the West Coast Bank America that was owned by, started by A.P. Giannini, that has the banker's marble heart out in front of its headquarters building. That bank back in the 80s was an SNL, had an SNL in the middle of its balance sheet and was a zombie bank. We're going to see that same thing repeated again and again. And to some extent, Morgan Stanley faces that same headwind.
We're looking right now at some regional banks that are continuing to report. Citizens Financial just came out with underlying earnings per share in the first quarter slightly missing at $1.10 versus the estimate of $1.13. Which banks of the regionals are you watching most closely to really understand the viability of this model?
Well, it's not technically a regional, but Bank America has, again, the new Bank America, not the old West Coast Bank America, has a SNL, underwater SNL in the middle of its balance sheet. It's got, investment securities that have a $99 billion unrealized loss in the held-to-maturity portfolio. And then it's got, $290 billion of residential mortgages. All of those are yielding less than, 3%. And yet their cost of funds, if rates continue to remain higher for longer, which is what Jamie Dimon is worrying about, the cost of funds are going to continue to creep up. So I think it's more of a 2024 problem than it is a short-term problem. In fact, we've been expecting a 20-30% rally in some of these banks into May.
Charles, you and I have been doing this since the Wells Fargo Pony Express was going across the tundra. And the answer is you and I know the short solution is layoffs. And we're seeing some rationalizations of headcount here in this earnings season. Do you predict over the next quarter, 1, 2, 3, 4, into 2024, that these banks are going to radically right-size headcount?
Yeah, and you're already seeing. I mean, yesterday we saw it in the numbers at Goldman Sachs and at Bank of America. So it's going to be business by business. One of the businesses that I think that there needs to be further rationalization is the capital markets, because I just don't see that business coming back this year.
Charles, thanks for that. Morgan Stanley in Focus a little bit later on this morning in the next hour. Charles Peabody there of Portales Partners. I want to pick up on Citizen Financial. Lisa mentioned the earnings out just moments ago. First quarter EPS in at $1, the estimate about $1.13. A little bit more detail here now for you. Total deposits, $172.19 billion, a touch lighter than the estimate of $180.68 billion. A bit more guidance and clarity on deposits from Citizens Financial. Deposits broadly stable through the month of March. Tom, I'm looking at credit provisions a little bit higher than anticipated. Deposits a little bit softer, lighter, lower than anticipated. But the guidance, deposits broadly stable over the month of March.
This is Citizens Financial, Providence, Rhode Island. Full disclosure, I interviewed once. The coffee was terrible. And, the bottom line is these banks, he's trading at 0.70 book, price to book. It's got a total return last 10 years now, 7% with a crater that we've had off this mini crisis we're in right now. And my question is, given I've never heard Charles that gloomy, when do the roll-ups start? When do the combinations, these guys just call up each other and go, the regionals go, let's get together and get some scale? When?
I've got to find out what's under the hood first, and we're trying to work that out right now. That stock, Citizen Financial, is down a little more than 6%. It's going to be a big week for some of the regional players. I think we've all got the same question now, Tom. Did you turn down the job because of the bad coffee?
Yeah, it was a bad coffee.
It was the bad coffee.
It was foreign exchange, and they were really polite. I loved it. They all had Bloombergs. It was great, lit up like a candle. And, it's a great bank. And again, it's this regional and super regional. I don't know where they fit into that anymore, but it's these regional banks below the four banks we talk, 24/7 about. There's a real mystery. Where are they in, Lisa, where are they in 3 years?
I mean, that's what Charles Peabody was saying, that basically they could rally 20 to 30% in the next couple of months because they're going to avert the pain. And then, wham, we're going to see the effects of longer-term math that does not make the position that they were in viable, that they were in for decades with 0% rates. And I think that's ultimately a question we're not going to get an answer to. So you just keep dancing until you get an answer and say, well, we can make some money.
Well, the equity market's been dancing. Futures are down this morning by 0.6%. Great lineup for you. Fantastic lineup of conversations just around the corner, including this one with Lizanne Saunders, the Chief Investment Strategist at Charles Schwab. A little bit later this hour, we'll catch up with the Ryanair CEO, Michael O'Leary. Looking forward to doing that with you a little bit later. Yields are higher by 5 basis points on a 10-year. Let's call it 363.
Did you ever fly Ryanair where you had to stand up for the trip?
No, you sit down.
You sit down?
Very tightly packed. On a 2-year, yields higher by 7 or 8 basis points at 427 from a beautiful New York City this morning. Good morning. From New York City, welcome to the program. Here's a flavour of the price action this Wednesday morning. I think it's Wednesday. Is it Wednesday?
It's Wednesday.
It's Wednesday.
It's
Thank you very much.
Wednesday.
Appreciate that.
You're not alone.
I told you, whenever we used to start the radio show together, Tom, I used to write down what day it was because it was so early. I'd always forget. Futures right now up 5 or 0.6% on the S&P. On the Nasdaq up by 0.8, or rather down by 0.8%. It's a softer session. We're negative across the board here. Just to repeat that, the S&P down by 0.5%. This is not a good start. In the bond market, 2s, 10s and 30s shaping up as follows. I'll get the direction right for you now. Yields higher by 7 basis points. Bottle this, TK. This is the best of 23. The 2-year right now, 4.2713. Yields repricing higher as we start to fade some banking stress again.
Yes.
Off the back of the latest earnings, Tom.
This is a Bullard market, and where people are reassessing where James Bullard is, which is, you know what? He's got a constructive GDP view. He's got a constructive view on we got to fight inflation. So the market resets away from the remedial effects of a banking crisis that may not come because maybe there isn't a banking crisis.
Morgan Stanley in the next hour. Let's talk about a couple of currency pairs and start with the euro dollar. Inflation looking sticky in the eurozone, 109.35 on the euro. Negative here by 1/3%. Inflation sticky in the eurozone. In the UK, double-digit CPI still above 10%. Quick word on dollar yen and the BOJ. Our latest reporting on the Bank of Japan from the team here at Bloomberg. I'll read you the lead paragraph. The full story, of course, available on Bloomberg.com and on the Bloomberg terminal. Bank of Japan officials are wary of tweaking or scrapping their yield curve control stimulus at the next policy meeting. This according to people familiar with the matter. Not a big move in dollar yen off the back of this story, I have to say. 134.82 on that currency pair, Tom. Still positive there by about 0.5%. Some dollar strength out there through G10 this morning.
The dollar strength there in euro yen does not confirm a yen move today. We're still within the trading band that we've seen. This is a great joy for those looking at the many narratives of the market. Liz Ann Saunders has written those narratives for years at Charles Schwab. There's no question, John, about it. I know you've got what she's been writing about recently, and I'm sorry, this is a good time to talk to Liz Ann Saunders.
Well, just to quote some of Liz Ann's work, here is the quote on the Federal Reserve. Given the Fed's strong desire to not repeat mistakes of the 60s, the 70s, we think parts of the market have grown too optimistic in pricing in rate cuts. Any quick pivot, Tom, to rate cuts would likely only occur in the face of more dire economic, labour market developments and/or a significant worsening of banking system strains.
When I go there with John is economic developments. I love how Ms. Saunders goes back to 60s and 70s. I mean, that's a perspective.
It's the fear of this committee.
Yeah, I think that we've all got our memories here, and maybe those memories are just that, memories and not the clear and present. Liz Ann Saunders joins us now with Charles Schwab. Liz Ann, the clear and present for you is factor analysis. My problem is maybe I've got 5 ideas or 10 ideas. Torsten Slok over at Apollo says maybe there's 20 ideas. How do you find the 21st security to own? I mean, it's just really difficult out there to do stock selection towards quality and positive free cash flow.
Well, interestingly, the last couple of weeks, you have seen a more definitive bias from a factor perspective toward, and this may seem obvious, but it's finally working its way into factors, is interest coverage. So and by the way, second to that would be strength of profit margins. So I think this is really a story of who can maintain profit margins in a declining, nominal inflation environment, which had been a real support for pricing power. Now we're going to have to see who's actually got the pricing power and who can cover that interest. But as we've always said, you can apply factor-based screening across the spectrum of markets. Too many people think, all right, I have to start with a sector or two and then apply screening within. You can find value characteristics or factors within stocks and areas that might be perceived as just in the growth area.
What you just heard there, folks, bottle. This is off of Tushar Shande of the Massachusetts Institute of Technology 1,000,000 years ago. I can't say enough about the need to go cross-sector in analysis within sector. This is gospel for me and Liz Ann. Okay, Liz Ann, I've gone cross-sectors. Let's go type 2 negative. What do I want to avoid?
I think you want to avoid, to some degree, the opposite. You want to avoid the companies that are not self-funding, the zombie companies that don't have the EBITDA to cover interest expense, that can only fund their operations on the back of additional leverage. We had, I think, close to 30% of the Russell 2000 at one point last year could be classified as zombie or pretty close to zombie companies. So I would certainly avoid those. And you do get a lift like we saw in January down the quality spectrum in the non-profitable area. But I think this is decidedly a place where you want to focus on what's dear, positive earnings revisions, the interest coverage, strength of balance sheet, high cash, low debt. The opposite represents where you want to avoid.
Right now, is the pain trade just higher, even among some of these zombies at a time where a lot of people point to stimulus that hasn't been fully worked out of the system yet?
I think the pain trade probably is still a bit higher. If you look at institutional speculators, recently they did hit a pretty extreme short position in the S&P 500. That, by the way, hasn't always been a contrarian indicator. Sometimes they're sort of dead on, as was the case in September of 2007. But I do think some of the short-term rallies that we've seen in this market, particularly concentrated in January, did represent a lot of short covering and the pain associated with that. So there is still a decent amount of bearish positioning, and that could provide some support for the market. But I also think the market has recently gotten a little bit overbought, not to mention the fact that we've reverted back, short-term anyway, to a negative correlation between bond yields and stock prices. So this recent move up in bond yields has been met, certainly on a day like today, with a little bit more weakness in the equity market. And I think that negative correlation is likely to persist, maybe even in a secular way.
Wait, this is important, Lizanne, because a lot of people are wondering, okay, can we go back to 60-40? BlackRock Investment Institute said, please don't, not yet, it isn't time. And what you just pointed to, what you just said in terms of a secular change would suggest you agree.
So from the 60s to 90s, kind of mid to late 60s to the mid to late 90s, you almost the entire period on a rolling 120-day basis had a negative correlation between bond yields and stock prices, because that was an era of more inflation volatility. So often when yields were going up, it was reflecting inflation having been let out of the bag again, negative for the equity market. Then fast forward to the Great Moderation era, as coined by Larry Summers, basically the 20 plus years heading into the pandemic. Almost that entire period, save for a brief period in 2008, you had a positive correlation, because even during that era, when yields were going up, it was typically not reflecting an inflation problem, but stronger growth, positive for the equity market. I think we're going back to that environment like the 30 years prior to the Great Moderation, which is more inflation volatility. That is not the same thing as saying inflation is going to stay high in a secular way, but just more volatility and inflation. And for the newbies out there who haven't been around as long as I have, it's just a different investing backdrop. It's not necessarily significantly worse. It's just different relative to the era of the Great Moderation.
The era we're in, Lizanne, and Schwab is a guilty victim of this, is selling us on index funds. And we're all indexed up to our eyeballs, and we're particularly indexed up to broad indexes. Are we over-indexed, and do we have to go more specific, narrow index, or dare I say even individual stock selection?
So we've always espoused the benefit of having both passive strategies within a portfolio and active strategies. And as you all know, last year was a year where active had its best year relative to benchmarks since 2005. And I do think in general that the playing field is getting more level, that active has the ability to operate relative to passive in a beneficial way, unlike what we have seen in the recent decade or two. And I think in part that has to do with the return of the risk-free rate, the fact that when you had rates at zero and negative in other parts of the world, it kind of mucked with price discovery and capital misallocation. And I think we are reconnecting fundamentals to prices. And I think that price discovery that is allowed by the return of the risk-free rate, I think, is to the benefit of active. That does not mean sell all your passive funds and become a stock picker. I think there's still a home for both, but I think active managers are just operating on a better field right now in terms of being able to outperform benchmarks.
Lizanne, a clinic from you. as always. Thanks for being with us this morning. Liz Ann Saunders there of Charles Schwab on this equity market. On single names, I want to pick back up with Citizens just briefly. I don't know if Mohammed Al-Arian works on the board of Citizens, but here's the headline. What happened in March was not a regional banking crisis. Another name, another voice suggesting it was not a crisis. This coming from a smaller bank in the United States, saying what happened in March was not a regional bank crisis, and going on to provide a little bit of guidance as well. They now see full-year net interest income at plus 5% to plus 7%. They had seen full-year net interest income at plus 11 to plus 14. So a slight downgrade there, Tom, to the outlook at Citizens.
It's a downgrade, and maybe it has to do with the rate structure, maybe even has to do with the spirit of the economy and all. But, Liz Ann brought up the zombie concept, which I've been beating the drums on. I'm not saying these banks are zombies. I'm saying strategically to compete, particularly with the Zelle statistics yesterday from Brian Moynihan, digital banking. How do they compete? I'm not sure how.
I'll pick up on that. I think that you're right. How do you sort of say, okay, you're not, hold on a second. It's not a zombie. It's not a crisis. It's a slow bleed. It's a slow questioning of a business model that is much more challenged when rates are where they are and people are more selective about where they put their deposits. That's the distinction. It is harder to see it in real time. And perhaps that's the reality, as we were talking about yesterday with Jim Zeltner. I mean, to me, that is the issue. This is going to take time, and it isn't necessarily a wholesale collapse.
The start of a process. Keep going back to that phrase, don't we? The start of a process.
A journey.
My friend, maybe even a journey.
It's a journey.
My friend messaged me yesterday evening and talked about Apple and just how easy it was just to transfer cash and let's go, 4%, thank you.
Why wouldn't somebody do that?
Well,
new world.
But this is the heart of the matter, and it's the ease of transfer. This is the digital thing that got Silicon Valley into trouble. I mean, I'm sorry, you can do it off your cell phone, right?
Deposits are still super sticky. I mean, I'm speaking for myself. They're still there, earning zero. You just sort of like, one day.
There was actually, Bank of America said people tend to not move it. So you're not alone. Don't worry.
It's a real thing.
I know.
It's a real thing. Coming up shortly, Michael O'Leary, the Ryanair CEO. Looking forward to that conversation in just a moment. Your equity market is negative to start this Wednesday morning. We're down about 0.6%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fox News will pay $787.5 million to avoid what could have been an extremely embarrassing trial. Fox agreed to settle a defamation lawsuit by Dominion Voting Systems over the network's 2020 election broadcasts. Dominion says Fox defamed it by airing claims it rigged the vote. Evidence showed that Fox executives and stars derided the conspiracy theory, even as they promoted it. It's official, India is now the most populous nation in the world. According to the United Nations, India's population is now almost 1.43 billion, edging out China. The increase will put more pressure on India's Prime Minister, Narendra Modi's government, to create jobs. In Moscow, the defense ministers of Russia and China have promised to expand military cooperation. It's a sign of the strong ties the two countries have sustained since Russia invaded Ukraine last year. And it comes at a time when Beijing has been trying to position itself as a peacemaker in the war. Bloomberg's learned that Disney plans to cut thousands of jobs next week. That includes about 15% of the staff in its entertainment division. In February, Disney said it planned to eliminate 7,000 positions from its workforce of more than 220,000 as part of a cost-cutting move. And hedge fund billionaire Ray Dalio plans to set up a branch of his family office in Abu Dhabi. It's part of his deeper push into the Middle East. The Bridgewater Associates founder has cultivated a close relationship with United Arab Emirates leadership over several decades. Dalio's net worth is estimated to be worth more than $16 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
That's the long way of saying we're going to hike in May. Philip Lane, the ECB chief economist, speaking yesterday at the Bloomberg New Economy Gateway event in Dublin, Ireland. Live from New York City, welcome to the programme. Your equity market negative this morning. We're down on the S&P 500. Lighter, softer, lower on the S&P by 0.5%. Yields a bit higher by 4 or 5 basis points. The 10-year 362 on a 2-year yield, higher by 6 basis points to 426. Yields higher, double-digit CPI in the UK, sticky inflation in Europe. Bank earnings in America, not terrible. Not terrible at all. In fact, we get a little bit more, don't we, Lisa, this morning? This from Bancorp, US Bancorp. First quarter total average deposits, $510.32 billion. The estimate, $521.54 billion. The stock, Lisa, negative by 8 or 9% in the pre-market.
Yeah, so this isn't necessarily meeting expectations, but it still isn't catastrophic, and that's basically the bar that they had to cross over. They said that the average deposit growth that they had year over year was about 12.4%, and that the average loans also came in broadly in line, nearly at $390 billion. So again, they missed on a couple of things, but it wasn't catastrophic. So the shares are hanging in there; they're not just tanking, and this sort of feeds the narrative. Banking crisis, perhaps, isn't the right way to say it.
We haven't had a shocker yet. I don't know if we will. It's not a judgment about the future, just an observation about what's happened so far.
So defensive.
I'm just waiting for people to kind of message me like, yeah, you see.
Exactly.
You'll see. You wait until Monday. We haven't had a shocker yet. Citizens down, Tom, by 1.5%.
I've had to be difficult here. Lisa's had to dust off the surveillance cork, in that, to me, these are busted marketing schemes in the gauze of being a bank. And that's a pretty severe view. But there's a lot of regular banks out there like U.S. Bancorp, Citizens, and the rest that aren't doing 10-year delayed principal payment mortgages for next to zero interest to be sure your VC transaction works out.
Just say the name, Tom. Talking about SVB.
No, I wouldn't be doing that.
Okay.
But,
He already has
I like the
basically.
idea of adults running a real business, adapting to what has been clearly a hurtful crisis a lot of people affected. Right now, and this is a joy because Lisa and I have no idea what we're talking about. It is the guy who changed the airline business. Yes, it came over to the United States, but more than anything, Michael O'Leary is someone that the United Kingdom and all of continental Europe knows. I learned this from my daughter the first time she said, "Dad, Dublin this weekend." For John Farrow, it's simple. The flight he takes is from London. Is it Luton, John? How do you pronounce it?
Luton Airport.
Luton Airport.
Yeah.
Luton to Naples, $68.
I can't remember if it was Luton or Stansted. I think it was Stansted to Bari. That's what we used to do.
Okay, there it is. Why don't you bring in Mr. O'Leary, since you've flown 5,000 times on Ryanair?
Michael, good morning to you. Let's talk about how business is going, because in the United States, we look at some of the airlines here and things are booming. Is it the same thing, Michael, over in Europe?
Good morning, guys. Yes, it is. It's booming and getting boomier. EasyJet released quite an up-tempo pre-results statement yesterday. I'm afraid we have our full year results at the end of May, so I'm in a closed period, can't comment, other than what we previously said is, as we emerge out of COVID, demand for air travel across Europe this year is very strong. Pricing is rising. We're seeing the benefit of people going back travelling all summer long. And there's an invasion of Europe being, I'm pleased to say, reports being taking place by Americans coming over here to play our golf courses, visit our beaches, join in our cultural experiences. And I'm very pleased to welcome the Bloomberg New Economy Gateway Conference here to the Garden of Ireland in Wicklow this morning. Although I'm suffering from hay fever, it's not a good day to be in the Garden of Ireland.
Well, Michael, I'm sorry to miss you over in Ireland. Let's pick up on Europe. Capacity. There is a frustration with travellers in the United States. When's the capacity coming back on so that we can get better airline fares and we can be a little bit more comfortable, Michael? How disciplined are you being about that?
We're not. We're taking as many aircraft as we can from Boeing. This summer, we're going to be operating. We plan to carry about 185 million passengers this year, which is up about 30% on our pre-COVID numbers. So as soon as we can get the aircraft from Boeing, we're flying them. But overall, short-haul capacity in Europe will still be down around 5 or 10% on pre-COVID capacity. Some of the European airlines have gone bust. The Thomas Cook's, Flybe, Alitalia, TAP have only returned at half the size they previously were. Aircraft capacity in Germany, where Lufthansa is doubling prices, is only operating at 80% of pre-COVID. So capacity is a challenge. And I think over the medium term, the inability of Airbus and Boeing to deliver any meaningful increase in production means I think capacity is going to continue to be challenging for the next 2, 3, 5 years.
I look where we are, and to me, sitting on the runways, it's about a limitation of airports, whether it's continental Europe or the United States, maybe even Asia. But there just doesn't seem to be enough airports and enough gates. Are you waking up every morning saying to yourself, we've got to get the underlying infrastructure rebuilt for 2030?
No, well, I think there's a differential, Tom, between the U.S. market and in Europe. In Europe, there's many more airports available. There is a focus on 3 of the big hub airports, Heathrow, Paris and Frankfurt, Main, which have never really worked that efficiently, those hub and spoke airports. They're challenging. But there's lots of other airports, second city airports and secondary airports at main cities, which is essentially where Ryanair flies to. The big challenge for us in Europe is air traffic control, which continues to be a mess. The French air traffic controllers going on their recreational striking 2-3 times a week. The French use minimum service legislation to protect the French domestic flights, and they cancel all the overflights.
Okay.
We've been calling repeatedly on the European Commission, Ursula von der Leyen, to do something to protect overflights. So we don't have any issue with the French going on strike, but if they're going to go on strike in France, cancel the French flights and leave the Spanish, the German and the Italian flights alone.
As recreational striking takes up around Europe and frankly probably globally, I'm curious how much that jacks up salaries and allows people to absorb some of the price increases that you've put out there for Ryanair tickets. And we've seen pretty much across the board, it is getting more expensive and people are paying it without even thinking. When does it become too much? Have you sort of tested the barriers of when people start pushing back?
I don't think, Lisa, we've tested the barriers, but I mean, it's a very unusual, I find myself in a very unusual situation here in Europe. Everybody's talking all winter long about energy crisis, consumer prices, rising interest rates, yet fundamentally we're dealing with an economy across Europe where there's full employment. People are receiving their wages at the end of every month and they're spending money. I mean, I think it feels almost like, I don't know what the 1920s were like after the Spanish flu or the First World War, but it's almost like people are determined to spend and spend on travel in particular. I think that being locked up for 2 years with COVID has driven people back to the beaches of Europe. People have money and they are spending it. It is very difficult to get a restaurant reservation, a hotel or a flight in Europe. Now, Ryanair is still offering the lowest fares in every market in which we operate, which is right across Europe. But even we're seeing our fares. Last year, we saw fares rise by 14-15%. We think this summer, and I'm on record as saying, I think it'll be we might get to double digit again, maybe 10% increase in airfares. But that's been 2 years in a row of double digit airfare increases. So people are spending. I think we're nowhere near American level of airfares. Southwest's average fare last year was about $110. Our average fare last year was 44 euros. So it's still much cheaper to fly in Europe. But there's no doubt that it is getting a little bit more expensive, particularly as we move through the summer of 2023. But remember, this is the airline industry, and when things are going well, it means the next crisis is probably about 4 days away.
Michael, or another strike. Michael, thank you for being with us today. Michael O'Leary there, the Ryanair CEO, taking some time to catch up with us, even in a quiet period, and we appreciate that. Tom, double-digit increases for airfares.
Yeah, well, we're all living it. Again, I think our American audience isn't familiar with this. There's no frequent flyer miles with Ryanair. You pay $200, and that gives you the ability to choose your seat. You remember running to the aircraft?
Oh, yeah. No allocated seating.
40, 50 people?
No allocated seating. So what you would do is you would line up very early, hours before the flight, and as soon as you went first, everyone else started piling up behind you, and then they'd let you through, and you'd sprint onto the plane. And I'd always try and get the exit seats because they had more room, more leg space. Yeah. And then you'd sort of put your bags across the chairs and say, no, that's for mum and dad. That's for my sisters. And you try and block everyone off. But, it was chaos, Tom. It was absolute chaos.
But the fares there, I remember, this is when an offspring, this is the middle child, was flying around Europe every weekend, and it was cheap.
I could get a ticket to Italy for 15, 20 euros.
Like 15, Lisa, 20 flying pounds. To Washington is outrageous what it costs.
So
it's outrageous.
Can you still get those cheap flights? I'll ask that. At this point, is it the same kind of story? And, oh, by the way, do you still have to run to get the seats? And do you still block off seats? You were that person? Really?
Of course.
Oh, jeez.
I got there first.
And then you booted everybody else out. I can imagine the fist fights.
I was a kid.
Is that your justification?
It has been a very thin rally. There's certain parts of the market that are doing well, others that continue to struggle.
It's remarkable the way that the economy has performed in the face of such rapid increases.
The consumer balance sheet overall is in good shape. Business balance sheet overall is in good shape.
There is still a lot of residual tension related to liquidity within the banking system.
You're in a transition period. We had 14 years of low interest rates, and the real impact on valuations, it takes a while to filter through.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here's the good news. Things aren't terrible. Live from New York City this morning.
Wow.
Good morning.
Bramo optimism.
Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures right now negative on the S&P 500 by 0.5%. But let's take a snapshot of some of the regionals in the last 24 hours. Western Alliance flying at a pre-market up by more than 18%. Other names, Citizens, US Bank Corp, just doing okay. And doing okay is good relative to the fears of the last month, Tom.
Really is, and it comes off, let's remind ourselves, off the big banks with a revenue pop that we saw at some of the major banks, including J.P. Morgan. I'm not sure we see a revenue pop here, but what's different is when the Bloomberg headlines come out. Excuse me, I got the plague today. When you got the headlines coming out, John, they're leading with those deposit metrics that people want to know. That's the mystery, and it appears to be good news.
That's where the focus is. Stable. Stabilization is this word we keep coming back to, Lisa, over the last couple of days.
Yeah, because honestly, they did miss. Let's just be honest. They missed with the deposits. They missed on some of the earnings. There was not necessarily this incredible strength and roar of just, everything, all systems to go. And the stock's pretty much flat in the pre-market trading, which shows you people were expecting Armageddon for these banks. They basically had priced in a true credit collapse in some of the regional firms that isn't happening. So does that signal all clear, or does it just signal that, a tail risk is taken off the table and that basically all the bad news has already been priced in that could come from tighter lending
It's all
conditions?
relative. I said it at the start. The good news is things aren't terrible. The decision you have to make now, and we keep leaning on this. This is how things stand at the moment. Do you see the last month as a one-off event we can leave in the past, or the beginning of a process that leads to tighter financial conditions and, Tom, tighter lending standards?
I would editorialize it this morning with the VIX at 17.47. We'll do the data in a moment. We are beginning to price in a Fed that's moving from bank crisis to bank distraction. That's how I'd put it. You see it in the 2-10 spread, which is very elegant with a support. It's 60 basis points of inversion, and we're now down at 65, breaking through that support, which goes back right to the crisis of, let's call it, March 10th.
We're pricing out rate cuts at the front end of the curve. The 2-year is higher, repricing higher by 6 basis points. The 2-year right now, 4.26. That move has been validated to some extent by some of the recent data from the Federal Reserve on bank lending, on bank loans more broadly, and Lisa, encouraged by some of the Fed speak over the last couple of days as well.
Basically saying, look, guys, we still are going to keep rates high for a longer period of time, and so you are seeing only 0.5% of rate cuts being priced into the market through the beginning of next year. So still, there is that kind of expectation. I will say what Ryanair's CEO, Michael O'Leary, just said really struck a chord with me. This idea that people have money and they want to spend.
Boom time.
Boom time. And it's getting boomier, to use his words. And this idea that they're willing to pay up for tickets, even though the experience, not necessarily Ryanair, but generally, is getting more miserable. I'm just saying, this tells you where we are,
like
and that just keeps going.
Who's been stranded at Hartsfield in Atlanta three times.
Don't need to bring this
with
up.
Delta.
3 times.
With Delta.
No,
There's a brass plaque down Terminal
airlines.
C. There's a brass plaque in Atlanta. Bramo set up shop
Look
here.
at those markets.
Do you want me to look at the markets?
Yes.
I'll do that for you. Okay. The equity market more broadly on the
vacations.
S&P 500 down about 0.5%. I'll whip through things for you just on a surface level. Then Lisa will give you the day ahead in just a moment. Equity softer, yields higher. We've talked about the 2-year. Let's talk about the 10-year. Up 4 basis points here. The 10-year 362 in the FX market. Just a touch of dollar strength here, Tom. Euro dollar 109.33.
Again, indicating crisis over. The 10-year real yield really breaks out 1.31. I don't want to make 1.32 actually. I don't want to make too much of it. But I would suggest to May 3rd, we're seeing a reset this morning, moving beyond angst of what Secretary Yellen will do about the banking crisis. Well, you know what? maybe there's nothing to do but figure out the marketing schemes that went wrong.
I think we hear from her on China a little bit later this week as well.
There's a lot to say on China.
Looking forward to that. Lisa, just looking at crude briefly, just a break of 80, sub 80, 79 on WTI.
Well, today we're going to be watching bank earnings. We haven't mentioned Morgan Stanley. Does anyone care? We've seen Morgan Stanley shares do okay so far year to date. That comes out around 7:30 a.m. Again, though, that's not really where people are focused right now, because the existential crisis that wasn't, perhaps, really is in the regional banking sector. We got Citizens, we got U.S. Bancorp, not anything fantastic in terms of some sort of catastrophic surprise one way or another. Do we get that same tone from Signature, Silvergate, Zions Bancorp, which will come out after market today? We have seen those shares all pummeled so far, with Zions down 38% year to date. So what kind of confirmation or a rebuttal of some of that weakness do we see in the results? 2 p.m. we get the Fed Beige Book. The bifurcated nature of inflation, of growth, is what I'm watching at a time when people don't know what to make of this economy. That is what I read from Bloomberg Financial Conditions Indexes, going from deeply negative in the immediate aftermath of Silicon Valley Bank to basically bouncing right back. Crisis over. Is it? Where are we in terms of this economic cycle? Fed speakers are going to be trying to make sense of that, whether people listen to them. Another story, Chicago Fed President Austin Goolsbee will come out at 5:30 p.m. Very interesting, after he talked about the need to be cautious with rate hikes. And New York Fed President John Williams at 7 p.m., who has been a little bit more hawkish in terms of we need to raise rates, we're not going to cut rates. And John, that is the debate playing out under the surface in markets, with people saying, okay, well, we can't sound the all clear in terms of Fed actions. And I don't know if 60-40 is going to work in that kind of environment so consistently.
Let's build on that. Lisa, thank you. Joining us now is Tracy McMillan, the head of Global Asset Allocation Strategy over at Wells Fargo. Tracy, welcome to the programme. Always good to see you. Do you see reason elsewhere to price out the rate cuts priced in over the last month?
So we do see a reason for pricing those out. We do think that the Fed is near its terminal rate. And actually, when markets tested it going any higher, that was back in March. We saw some breakage in the financial sector. And so we have had expectations pull back since then, to the point where we were seeing rate cuts priced in, but we think that's going a little too far. We expect, another 25 basis points here in May, and then the data will determine if we get another in June, but we think they hold from there, and probably 2024 before we see those cuts.
Tracy, to your incredibly smart note, buried in it, you midpoint SPX at 4,100. We're basically there right now. If we go to 4,200, or dare I say 4,300, do you suggest people hold and understand they may pull back? Or do you lighten up if we get this bull market to continue?
What we've been telling investors is that we're probably going to end the year about where we are today. And that's not only in large caps, but across the equity asset classes. So if we move towards the top end of that range, then we think it's an opportunity to start to trim and move back in if we go back to the lower end of the trading range. And that's going to be in the 3,800 area within the S&P.
Tracy, when was the last time that you were this tactical about when to enter or exit at a time when the fundamental stories change every day and it's very hard to get a narrative?
You're absolutely right, Lisa. It is hard to get a narrative, but our narrative has been very consistent over the past year. We've been more conservative. We have had an underweight to equities relative to fixed income, but for the past, call it 6-8 months, we have seen this trading range develop, and the equities are just having a difficult time getting past that 4,200 level. And we think that there is a recession ahead of us. Economic conditions are going to weaken. And so we take advantage of this strength here to reposition into a bit more into conservative assets like bonds.
So people who are more conservative say that, the equity market hasn't been able to break above 4,200. The bulls out there are saying the fact that the stock market is hovering around these levels shows just how resilient the economy is amid all this bearishness that has gotten completely overplayed. How much of a pain trade is stock markets going up at this point, given what some people are pointing to as decade records when it comes to bearish positioning?
The bearish positioning matters less to us than the valuations and the conditions that we see in the second half of this year. So we do see the economy starting to weaken. We do see a recession ahead, and we do see an earnings recession developing. We think earnings are going to fall in the S&P 500 to about 205 this year. And we just don't think that all of that is priced in yet. And also, I would point out that even in bearish conditions, we have seen markets move lower. So it is possible for that to happen.
Tracy, wonderful to get your perspective on a market that is slowly repricing those rate cuts. Tracy McMillan there of Wells Fargo on the bond market, some of the recent data we've had, and of course the bank earnings of the last week or so as well. Tom, we need to talk about companies, to borrow a phrase from a wise man. What do companies do, Bramo?
They adapt and adjust.
Well done.
Thanks.
They adjust and they adapt. They also cut staff too.
Yeah.
Lots of jobs to go. Meta, Disney. The latest news on Meta, according to a memo seen by Bloomberg News, the Facebook parent company told managers that they should prepare for job cut announcements today. Tom, layoffs across Facebook, WhatsApp and Instagram.
And Disney, I think, in the mix as well. I would also suggest companies have learned that you don't come out with a big announcement. And particularly on Wall Street, maybe it's 20 here, 50 there. On Thursday, we'll do 400, 22 worldwide, whatever. But there's a more sophisticated way of doing this now than previous joyous times.
Would you say that the tech companies have embraced the sophisticated way of doing that? Because Facebook has not been shy about making cuts. In fact, that's part of the strategy, isn't it?
Yeah, the zeitgeist here is that these Silicon Valley titans have figured out, we get more done with fewer people. What a shock that is. That's Roger Martin 101 from the University of Toronto.
They also hired a lot of people. They hoarded labor who didn't necessarily even have a job,
guessing
right?
COVID,
I mean, there was a lot of excess for them to
Yes, there was an excess developed, but they're also finding there's an improvement in process when you get rid of the excess. And it's really, I mean, Amazon alone is a study right now.
Oh, the pre-pandemic and the pandemic boom. The pandemic boom of hiring at Amazon is still just absolutely phenomenal. The workforce essentially doubling over a couple of years. Your equity market negative this morning, down 0.5% on the S&P 500. Morgan Stanley results this hour.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Republicans will vote next week on a bill to raise the debt limit and impose new cuts to government spending. President Biden and other Democratic leaders are refusing to offer any concessions. Republicans are betting that if the House passes the bill, that can ramp up pressure on Democrats to consider compromises. The debt ceiling has to be raised or the U.S. runs a risk of a default. Another strong inflation reading is raising the likelihood for more interest rate hikes at the Bank of England. Britain's Consumer Prices Index rose 10.1% in March from a year ago, driven by the strongest increase in food prices in more than 4 decades. The pound edged higher and UK government bonds sank after that report. Fox News has avoided a potentially embarrassing trial. The network agreed to pay $787.5 million to settle a voting machine maker's defamation lawsuit over its 2020 election broadcasts. The settlement was for less than half of what Dominion had asked for, but was far above some analyst estimates. Fox has aired bogus claims that Dominion rigged the vote against Donald Trump. U.S. lawmakers have accused Credit Suisse of impending its own investigation into its historical assistance to the Nazis. The Senate Budget Committee says the bank established a narrow scope, refused to follow new leads, and removed an independent ombudsman overseeing that probe. Now, Credit Suisse rejected what it calls misrepresentations and says it's cooperating with lawmakers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
American debt is a ticking time bomb that will detonate unless we take serious, responsible action. Yet, how has President Biden reacted to this issue? He has done nothing. Defaulting on our debt is not an option. A no strings attached debt limit increase will not pass.
Folks, we know there's more to do. And yet yesterday, the Speaker of the House of Representatives, Kevin McCarthy, went to Wall Street. He threatened to be the first one to default on the debt, which would throw us in a gigantic recession and beyond, unless he gets what he wants in the budget.
House Speaker Kevin McCarthy and President Biden talking at each other and not with each other right now, and that's a problem. Might become a bigger problem later this year. Live from New York City, welcome to the program. Let's talk about the next hour, never mind later this year. In the next hour, earnings from Morgan Stanley. Shonali Bassett dropping by the studio to get us up to speed on that. She'll break it down for you when it drops. The broader market looks like this morning. Negative on the S&P 500. We're down by 0.5% on the S&P. More broadly into the bond market, yields higher by 6 basis points on a 2-year 4.26. I think the theme at the moment, Tom, just repricing that rate cut story, pricing out some of those rate cuts.
Yeah.
Potentially a discussion about pricing in some rate hikes. Don't think with that just yet. In the FX market, some dollar strength reflecting some of that. Euro dollar negative here, 1/3%, 109.32.
I'm not the rate cut analysis. I'm to what are we doing about a rate rise? And the answer is it's more evident this morning. I do want to point out, John, with all the enthusiasm and worry, the VIX 17.43 is still remarkable. Remarkable as well in Washington, our Bloomberg Washington correspondent, always remarkable, Amory Horton. Amory, I want to talk about in a clumsy Washington day, the drip that we're getting from this theft of our intelligence secrets. Is it just understood by people like you that we need to get used to every day? I mean, today in the Washington Post, it's China with a super spy drone, whatever. But are we going to get used to where every day for the next 30 days we're going to see new information come out?
I think that's right. We just don't have an end date. There's really no timeline that we could forecast when this would end. I mean, remember, the U.S. government didn't even know these documents were circulating when they first were put on Discord. But potentially today we'll actually get some more information because that individual is to be due in court. He has not yet said what his plea will be, but he is to have a court date today. So potentially there's going to be more information that the U.S. government has regarding the caliber and level of intelligence that this individual was able to leak.
An unfair question, but is this stuff so sensitive that the court process will be behind closed doors and private, or will it be a normal court case? Do we know yet?
We don't know yet. I mean, again, he has not even entered his plea yet. So I think for that, we just have to wait and see. And it's just unknown exactly how this is going to play out. But Well, you do bring up a good point, and just quickly, a totally different case, but the Fox Dominion case that ended up being settled, that was going to be taken. That was going to potentially have a little bit of cloak and daggers around it as well, with the jury selection and some of this stuff as well. So it really depends on the case, but we just don't know yet.
I want to shift gears a little bit because as we watch the drip of intelligence, we're also hearing about Treasury Secretary Janet Yellen giving the most extensive speech on China-U.S. relations since she took her position. I'm curious from your vantage point, do we have any sense of what she's going to say or why now?
So I would say why now is because she alluded to the fact that she plans to go to Beijing at some point. I think there's been some interesting rhetoric coming from the United States when you look at Secretary of State Antony Blinken's G7 meetings with foreign ministers leading up to the Hiroshima meeting on the ministerial level about engaging with China. And then the Treasury sends out this media alert, and I'll read you a little bit of it. It says that during her remarks, Yellen would underscore that in its bilateral relationship with China, the U.S. proceeds with confidence about enduring fundamental strength of the economy, historic advancement. They want to talk about national security, protecting human rights, and taking targeted actions to advance our vital interests where needed. So she's really setting up how the U.S. views their economic relationship with Beijing. And obviously, this comes at a very interesting time. The IMF is talking about fragmented geopolitics and how that can weigh on global growth. You have Emmanuel Macron leaving Beijing, saying that they do not want to decouple. And then Brazil's president, Lula, just got back from a trip to Beijing and criticized the United States for not wanting peace. So it looks like the U.S. wants to make sure their voice is heard.
And what is that voice? I mean, that's the issue, especially how closely it coheres with what not necessarily we heard from Emmanuel Macron, but whatever the European mainstream view is, whatever that might be?
I think it's that they want to make sure that they're going, combating China, competing with China, actually is what they would say. They want to compete with China alongside their allies. They want to probably set some guardrails, I imagine, in this speech. You can read the tea leaves of that, but also want to make sure there is a lane for engagement. Whether that's on climate or other major discussions, they want to make sure that they are getting back to the table and discussing with China. Remember, there is a number of issues that really sidelined a lot of these discussions since Biden sat down with Xi Jinping in Bali. Secretary of State Antony Blinken was supposed to go. Raimondo was supposed to go. Yellen's supposed to go. No one has trips planned, scheduled on the books. And that's because of fresh flashpoints in the Strait of Taiwan, the spy balloon, Xi going over to Moscow and not also calling Zelensky, but offering this peace plan. I mean, there's a number of huge issues between these two countries, and I think this is a moment they're trying to find an opportunity to engage on at least something like climate.
What's the president do today? It's a Wednesday. It's a complete nudge news flow. What do you do on a day like that if you're president of the United States?
Well, according to the White House, the president will be going to Maryland today, and he's going to be speaking to a union, and this is where they train. A union training facility. And according to the White House, and I have his schedule in front of me, Tom, it says he will be delivering remarks contrasting his vision for the economy with MAGA House Republicans' vision, an economy that goes from the middle out and bottom up. You've heard this before. This is almost a campaign event, but not so.
There we go.
Said in black and white campaign event.
I don't know what happens in the United Kingdom. Does the prime minister have a boring day? Does the president sit there and wake up and go, what am I going to do today?
You think that happens often?
I don't know if it's often, but it's, I think, really going back to the advent of the White House. It's
I think
normal.
your view on that probably depends on the party you vote for.
No, I just think they wake up and they go, it's Wednesday and there's no big events.
Well,
so
he has a Congress divided, and he's waiting for a debt agreement, or he's waiting on the Republicans to see his vision. He mentioned this yesterday. I'm sure today he'll talk about the debt limit as well.
Like the president wanted 2 scoops of ice cream, President Trump. What does President Biden want? Does he have
Biden wants the ice cream.
Does he want the ice cream
Biden wants the
too?
ice cream. I don't know why we're doing this. I think you're describing your day more often.
No, I think it's a nudgy day in Washington. They're allowed to have a nudgy day.
In Washington. TK wakes up. Is Morgan Stanley coming out this morning?
Yeah, I mean,
it's important.
Yes, it is. Are you sure? Yes, it is.
Shanali's so on it that I don't have to worry about that
Morgan
stuff.
Stanley is coming out this morning. Shanali, in the next couple of minutes. Good morning to you. What are you looking for
Remember,
from this
Morgan
name?
Stanley is the most expensive of all the banks. It is trading more richly than every single one of the large ones. And the reason is because the market loves what they've done with asset and wealth. I think what's interesting, and I was just looking at this, across all of the banks, it's not that people look at Goldman Sachs yet and say, okay, let's value this based on the asset and wealth manager. Same with JP Morgan, even though it's among the highest returns on equity at the bank. And so does Wall Street start to shift its thinking around what banking means? Because the reality is the deposits and the loans are coming from that business.
Bloomberg with a great article this week on Mr. Saperstein, who's one of 3 to replace Gorman. Is Gorman like Diamond in that he's like chairman and CEO as well? Is it the same structure, dominance?
He definitely has a stronghold on the bank. And you think about the history of the leadership kind of struggles at the top and the fight even to be president of Morgan Stanley, let alone the CEO of Morgan Stanley. Andy Saperstein was a longtime lieutenant of James Gorman. I think what's interesting also is they come from consulting backgrounds. And I think they're showing that their strategy prowess that comes from consulting is kind of beating out the investment bankers these days.
Well, John comes from a consulting background.
I do, yeah.
Yeah.
An Italian family.
I didn't know that.
You learn very early. Shanali, thank you. Wonderful. Shanali's going to be with us as those numbers drop from Morgan Stanley. Then we'll catch up with Gerard Cassidy of RBC Capital Markets. That's basically the chain of events for the next 10 minutes or so, with equities down 0.5%.
Tell us about consulting in the kitchen. Do the dishes.
Oh, pretty brutal. Pretty brutal at dinner time.
Yeah.
You learned fast how to argue. That's for sure.
Yes, I grew up in the same environment. Just pitch battles at the dining room table.
Just, an important note. I would order so much ice cream if I was in the White House. Just all the time.
I know. You'd have
All
either
the time.
lemon, gelato, ice cream or gelato.
Just ice cream, just vanilla, but a really, really pure, wonderful vanilla ice cream. Equities lower this morning. Good morning to you. We're down 0.5% on the S&P 500. Welcome to the programme. We're down 0.75% on the Nasdaq 100. Outside of that, in the bond market, repricing yields higher over the last couple of weeks. Your 2-year has gone from the 350s at the end of March back through 4%, 426, very close to 430 a little bit earlier this morning. Yields higher by 6 basis points on a 2-year. On a 10-year, yields up by 3 or 4 basis points. On a 10-year to about 361. Some numbers from Morgan Stanley to wrap up earnings season for the big banks on Wall Street. Shanali Basak alongside us. Shanali, what have you got?
Let me give you the first blush here because you have equity sales and trading revenue coming in below analyst estimates. We'll talk about that in a second, why that's a big deal. You do have fixed income sales and trading coming in above estimates. That makes 4 of the 5 biggest banks coming in above estimates there. You have wealth management revenue coming in above estimates as well. That is, the behemoth in the room over at Morgan Stanley. But on the equities number, listen, that means this is another quarter in which Goldman not only beat estimates, they also came in above Morgan Stanley in equities trading. This is a core business. They have traditionally been the biggest on Wall Street when it comes to equities trading. So what is happening? Are they losing share? Is this a client balance issue? Is this a market issue? It is a soft market when you look at the equities market. But remember, we are one large prime broker short in the world without Credit Suisse. So why isn't Morgan Stanley picking up more share?
First quarter wealth management, the revenue above estimates, 6.56 billion. The estimate 6.48. Just to look at the pre-market response to this, early days, of course, we're higher by a little more than 1% in the pre-market to 90.88. This line right here, I think this line important for the whole industry right now, Shanali. The investment banking activity continue to be constrained. No signs of that picking up at the moment.
It's looking ugly out there. And remember, we want to kind of dig a little deeper a little bit later on and see if they also are talking about their securities portfolio and if they're talking about the loans that they have on their book. Remember, we're watching all these banks in real time kind of work through all of these hung loans before they can get to the new set of lending. Remember, private equity is still out there raising money. We had Goldman yesterday saying the fundraising environment is also kind of muted here. But again, they are looking to the end of the year to pick back up. Headcount right now is up at many of the big banks still. Do they have work ahead of them is the really large question here. I also want to, real quick, Tommy, I want to look at the asset flows here really quickly because remember, Morgan Stanley is supposed to be the biggest beneficiary here of the Silicon Valley Bank troubles here. And investment management has net revenue of 1.3 billion, even AUM of 1.4 trillion amid asset declines. They have higher net interest income, not only driven by higher rates, but people are taking out loans from Morgan Stanley.
They say this. I like it with Gorman with a paragraph right off the top of the note. And he talks about investment banking constrained, but I really like the comment, a very unusual environment. So how do they differentiate forward? What's the, you're so in tune with the zeitgeist, you're Shanali. Mm-hmm. How do they differentiate? It can't be just cost control and laying off bodies. There's got to be a strategy.
Listen, remember, Morgan Stanley still has this intense base of asset managers and financial advisors across the United States. When I talk to my sources there, they're having an easier time hiring, actually, because they don't have the same type of competition elsewhere, technology or other places that they might have had before. The asset flows of $22 billion is pretty interesting.
John, just buried here, or Lisa, quickly here, investment banking revenues down 24% from a year ago. I guess that sort of colors it.
Which is the reason why the diversification is so important for some of these banks that we've been hearing about time and again. Just real quick, Shanali, what do you make of the provisions for credit losses coming in significantly higher than expected? Still nothing to write home about, $234 million versus the estimate of less than $100 million. Is that significant?
The reason it's significant is because they now are just another bank that are telling you that they think that things are not kind of falling off a cliff here. But yes, the environment is getting tougher. So far, the banks have been rewarded for those provisions anyways, because it shows you that they're lending harder. They're willing to take on some losses in order to extend more loan and pick up what they can in net interest income.
All right, now Gerard Cassidy joins us. He's been such a friend of the show to give us perspective across these many different types of banks, not all pooled together. And Gerard, I want to start with a sentence buried in their very clear press release, which is all about Morgan Stanley, all about what you and I have witnessed over decades. In all this turmoil, down, 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 wealth management moved from a $5.9 billion revenue stream to $6.6 billion. Boy, Gerard, does that talk about why everybody wants to copy Morgan Stanley?
Tom, you're absolutely right. The wealth management business is a more predictable, steady Eddie type of business versus the more volatile institutional business that you guys have been talking about. Tom, you mentioned about how much the investment banking revenues have declined, not just for Morgan Stanley, but for the group. But wealth management, you're right, that differentiates Morgan Stanley from his peers. And under Gorman's leadership, he's the one that drove this over the last 10 years.
Jared, we've had all the big banks report now. Who won the quarter?
I would say that, the JP Morgan numbers probably stand out, John, as winning the quarter. They certainly drove those numbers through that net interest revenue line. Certainly, they also had, relatively decent capital markets businesses, but it was all against expectations. The numbers, as you guys have pointed out, relative to a year ago, was still very weak, especially in investment banking. But I would put JP Morgan at the top of the list.
We've been focusing very closely on total deposits at some of the regional banks. Here in Morgan Stanley reports first quarter total deposits been low the estimate, $347.5 billion versus the estimate of $352.2 billion. Does that matter, or is this basically not a question? It's a rounding error that we don't have to pay attention to, Gerard?
I think it's, I don't want to say we don't pay attention to it, since we pay attention to everything, but I think you're going down the right path, Lisa, that it's not a material issue. Deposits, we have to remember that the Federal Reserve is implementing quantitative tightening with the intention of reducing deposits out of the banking system after they created over $3 trillion under QE. So the entire banking system is going to see their deposits shrink. And the real question is the mix of your deposits. And the regional banks and the big money center banks, as well as Morgan Stanley, have good core consumer deposits, which are critical.
What's going to be the profit driver at a firm like Morgan Stanley if investment banking doesn't pick back up, if you are seeing transactions in the capital markets atrophy?
Lisa, it's really the critical question for these investment banks. It's out of their control, of course, in dictating how the market's going to behave in investment banking. So hopefully the first checkpoint will be monetary policy. The Fed has to stop raising rates. So if we get to that terminal rate in the second quarter, hopefully the second half of the year, you'll see a pickup in the investment banking activity because it's a more stable landscape.
Gerard, I look at the 2013 letter of Morgan Stanley written by Mr. Gorman, and there's a subtitle, Investing in Our Businesses. How's Eaton Vance doing? How's E-Trade doing? And all the other things he pieced together here to win at wealth management and managing people's money.
Tom, it's a very good point, because they have not only grown organically, but inorganically through the acquisitions that you just identified. And as we know, in the asset management business, which is, of course, Eaton Vance, economies of scale are critical. And so as they built their economies of scale, including their organic growth, as well as other acquisitions in the asset management business, that has obviously helped them. On the E-Trade, it's also given them a diversity of customers. As you know, E-Trade is more of a self-directed product line versus the traditional Morgan Stanley wealth management business. So it diversifies their revenues, and you have to give Gorman credit for doing those acquisitions.
Joe, just to wrap things up, just one question to you. We've asked this to investors. I'd love it from a bank analyst just to answer it. Do you see the banking events of the last month as a one-off event that we can leave behind, or the beginning of a process that leads to tighter financial conditions? How does a bank analyst answer that question?
From the get-go, John, I was saying to myself it was a one-off event. And the reason being is that those business models that Silicon Valley Signature had were so different. Now, that doesn't mean we're not going to see somewhat tighter lending conditions, not so much because of what happened in March, as it might be called March Madness. It really has to do with what the outlook is for the economy. And as Jamie Dimon said on his call, it's not a credit crunch. Yes, maybe there's a thumb on the scale, but banks are in the business to lend money at risk-adjusted rates of return. And if they see good risk-adjusted rates of return, they're going to lend money. So that's the real critical question. What is the outlook? Not necessarily what happened in March.
Joe, thanks for being with us so much through March Madness. And through April as well to break down some of these earnings. Gerard Cassidy of RBC Capital Markets. Just to recap Morgan Stanley, wealth management revenue a little bit better than expected. Trading revenue for FICC a little bit better than expected. Shonali, what do you see now? I've got, where's Morgan Stanley? Down by a little more than 1%.
I think that equities trading number is still a big deal. And to Lisa's point, that missing on deposits, there was going to be questions about that, certainly on the call. Remember, the number is higher, a bigger jump than they saw in the prior quarter, but it did miss analyst estimates. And the reason it's a big deal is after Silicon Valley Bank, after First Republic, presumably that clientele would have moved over to Morgan Stanley. So how much do they actually pick up? And that question of how sticky are those clients is something that will be asked more.
Also, the constraint on some of the capital markets business at a time when that was such a big profit driver. How significant and how deep is that constraint? Do we have any sense?
One thing that's interesting, and this is not quite investment banking in the advisory sense, but look at the value at risk at all the banks at the trading desks. They're inching lower. So in addition to provisions for credit losses, you also have them really dialing back on trading risk appetite. And again, with Morgan Stanley's client base, I would reckon that they would get some questions on the call too about that.
Usually, Shonali, I'd say, see you next quarter. Great work. But we've got the regionals now, haven't we?
Tomorrow's a long day.
Going to be just as busy.
And so is Monday with First Republic. Until we hear from them, it's hard to say we're out of the woods.
Off the COVID bottom, Goldman Sachs up 133%, Morgan Stanley up 231%. There's the delta.
Goldman's been doing okay, hasn't he? He's been doing okay.
It's you know, I love talking to him when we go to Davos, and you know, there's Shonali elbows me. She gets 2 minutes for elbowing. You know, she says, "You're not talking to Gorman. I'm talking to Gorman." And so, you know, she talks to Gorman, and you know what they're doing. I mean, Eaton Vance was a wonderful firm. Doze Gardner ran it up in Boston, totally classic. They invented the tax advantage mutual fund, literally invented it.
Right.
And he goes, we can acquire this and build it out. And that's the Gorman way, going back to Smith Barney.
Nobody else has done deals this big since the financial crisis, and he's inked 2 of them.
And is quietly. Yeah.
We done?
I'm done.
Shonali, thank you.
I'm done.
As always. We'll talk about those regionals a little bit later on. That's the banking
When do I
story
get to interview
for this morning. Anastasia Amoroso, the Chief Investment Strategist at iCapital, is going to be joining us shortly. We've been in this very tight, well-defined trading range for the last couple of months, 38 to 4,200. At the start of this month, Anastasia said we'd break out of it to the upside, and we're very close to doing so. We'll continue that conversation next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fox News will pay $787.5 million to avoid what could have been an extremely embarrassing trial. Fox agreed to settle a defamation lawsuit by Dominion Voting Systems over the network's 2020 election broadcasts. Dominion says Fox blamed it by airing claims it rigged the vote. Evidence showed that Fox executives and stars derided the conspiracy theory even as they promoted it. It's official. India is now the most populous nation in the world. According to the United Nations, India's population is now almost 1.43 billion, edging out China. The increase would put more pressure on India's Prime Minister, Narendra Modi's government, to create jobs. There's another sign that Tesla CEO Elon Musk is willing to sacrifice profits to boost demand. The electric car maker cut the price of its long-range Model Y SUV by more than 5% to just under $50,000. The cost of the Model 3 fell 4.7% to just under $40,000. Tesla reports first quarter earnings today. Bloomberg's learned that Disney plans to cut thousands of jobs next week. That includes about 15% of the staff in its entertainment division. In February, Disney said it planned to eliminate 7,000 positions from its workforce of more than 220,000 as part of a cost-cutting move. And hedge fund billionaire Ray Dalio plans to set up a branch of his family office in Abu Dhabi. It's part of his deeper push into the Middle East. The Bridgewater Associates founder has cultivated a close relationship with United Arab Emirates leadership over several decades. Dalio's net worth is estimated to be more than $16 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We've had a major, significant turmoil in the banking sector that came with a substantial intervention on the part of the authorities, and that will have to come with regulatory capital changes, regulatory changes, and all of that simply does not take us back to where we were before March 8th.
March 8th, that line in the sand before SVB blew up. Vishy Tripatur there, the chief fixed income strategist over at Morgan Stanley, weighing in on this price action. March 8th, the 2-year was north of 5%. The 2-year dropped to the 350s by the end of March, and now the 2-year is close to 430. Yields are higher this morning. Here's the price action. Up and away by 7 or 8 basis points on a 2-year, 427. On a 10-year, up 4 basis points, 362. The equity market's softer, negative, down by 0.5% on the S&P 500. If we can pick out Morgan Stanley, let's just breathe some life into the conversation around this bank again. Morgan Stanley in the pre-market's down by about 2.4%. Lisa, wealth management tick, okay, that's fine. Better than expected. FIC trading tick, okay, that's fine. Then this build for loan losses. What do you make of that?
Well, it was more than twice as much as people had expecting, more than $200 million. Still not a huge number relative to their balance sheet, but still, it highlights what Stanley was talking about. Some of these banks are willing to get more aggressive with their loans, and they just know they have to write more off as a result. And how much does this go to underwriting activity? How much does this have to do with really trying to capitalize on the fact that people are still spending, even though perhaps a greater proportion of them may not be able to pay it back in the future?
And just another note of caution, Tom, around the investment bank constrained, and that's more broadly the story right across Wall Street right now. IB is constrained.
IB is constrained. That's French for layoffs coming. And let's be clear, that's the easiest place to have bodies move out the door. It's just, these decisions can be made literally over a cup of coffee. There's other cost cutting that has to occur, which, particularly with the big banks, I really wonder about the future of retail banking. Like with COVID, do they continue to speed up the digitization
and move away from branches? How long have we been talking about that now?
Well, forever, but there's a real, I think, inertial force going on right now. We'll look at the banks, and as John mentioned, this continues in the coming days. Never before have we looked at the smaller banks like we're looking at them right now. And this is going to be good. This is what you need, folks. Should we talk to someone who just possibly got it right? Anastasia Amorosa joins us now, Chief Investment Strategist at iCapital. And I just love what you say. It's tough to be a bear right now. And this goes into the panic of I'm a bear and I've got to move away from that stance. Where are we in that continuum right now?
I think people are starting to have a little bit of a fear of missing out. I mean, the fact that this market has been so resilient around this $4,000, $4,100, maybe even $4,200 level, that's starting to get investors thinking. I mean, first of all, you had systematic investors, commodity trading advisors, CTAs, that have been in performance chasing mode already, or they had to keep covering the shores. You have the hedge funds that have been buying tech because they were caught being underweight tech. And I think that's going to likely spread to other segments of the market. Mutual funds have been underweight, so they may have to move into at least market neutral position. And then, of course, the retail investor. So, Tom, I think the longer this market hangs around these current levels and, the longer the economy is not cratering, that's going to get people back in.
Lisa, you had that great chart yesterday. You and other people put it, I believe, from Bank of America. That it was stunning, the gloom equivalency to 2008, 2009.
Okay, and not to just basically confirm my reputation as being gloomy, but is this basically...
No, I don't mean that.
But hold on a second.
It went viral.
There was this idea that
as
because
viral
things
as Bramo can be.
Are bearishly positioned, that we could potentially have a pain trade of stocks going higher. Are we just dancing while the music's still playing, even though we know it's going to end at some point?
Look, that's the uncomfortableness of it all, right? We can't sit here and make a call on what this economy is going to look like a year from now, and therefore the market is going to look from now. What we can say is we can look at the next quarter's worth of data and say, look, for now the consumer is resilient. For now we're managing to process 5% rates, and therefore for now the economy is cooling and not cratering. And so I think for investors, maybe this is a different way of thinking. We're used to saying, low interest rates are going to be with us for a while and just be in equities and there's no alternative. And now you need to be more nimble. You need to be more tactical and recognize that, maybe you don't want to, get out because that recession is not imminent yet, but the circumstances may change very quickly in the next 3 to 6 months. But for now, Tom, this economy is not falling apart.
Did you see the allusion there that Bramo made to the Titanic? The band kept
It was subtle.
playing. It was subtle. It was very subtle, but there it is. Like,
very Bramo-esque.
It's very Bramo.
To go there. What
Bramo,
about one
she goes
sector.
all Titanic on us.
What to talk about
Jack,
one sector.
Jack.
And it's not shipping, and it's not Leo and Kate. It is Meta up more than 80% year to date. Just a phenomenal move. Mm-hmm. And it's not just the rate story and pricing in rate cuts. it's the cuts at Meta and Facebook. Is there any reason to get behind some of these tech names that have already moved so fast, so quickly year to date?
Yeah, I mean, I think there are reasons. I mean, the valuation reason aside, the fact of the matter is tech is where most of the cuts have actually occurred. I mean, if you look at the earnings expectations for communication services and infotech, they're down 15% year over year earnings decline for Q1. And if you look at the revisions, they've been pretty drastic for those names as well. But then on the flip side, if you have the consumer that's not fallen apart, then maybe that actually bodes well for digital spending, for digital ad spending. So that bodes well for things like Google and Meta, for example. So I do think there's actually some fundamental reasons. And then outside of that, if you look at kind of the enterprise spending and if you look at artificial intelligence, this is just early days, and this is just getting started for the likes of Microsoft and Google as well. So I do think there are reasons. And John, the last thing, if you think about who has the solid balance sheets, maybe it's some of the banks, but sure is also some of those tech companies, and they're probably the least interest rate sensitive of the bunch.
Job cuts at Meta, job cuts at Disney. We'll talk about those Disney job cuts a little bit later on this morning. Price cuts at Tesla. You and I used to talk about thematic stuff around EVs quite a lot, and there were single names to do that. You would talk about the whole supply chain years ago, Anastasia. Where does the EV story go from here? How do you feel about things now?
Well, I think EV story is absolutely evolving, but the issue in particular around the price cuts is it's not just Tesla that's manufacturing EVs. There's probably 400 or more different car manufacturers that are trying to do this globally. So it's a highly competitive environment. So when you think about what is the best way to position in electric vehicles, for example, it's those enabling technologies. It's the batteries. It's the battery storage. And, by the way, you're going to need that for electric vehicles. You're going to need that to stabilize the grid that's going to be powered by solar and wind. So that, to me, is how you kind of approach that. But, to be in a highly competitive car maker space, guess what, John? Everybody's going to be there. And, it's inevitable that prices have to fall in order to incentivize the consumers.
Before we let you go, Anastasia, I remember when you came on here and you talked about private markets and how there were still a lot of opportunities there, even as some valuations did decline. What's your take on the state of commercial real estate, given all of the focus on that really underpinning some of the stress to come in the financials?
Yeah, look, there's obviously a lot of well-talked about risks. There is $1 trillion in commercial real estate loan maturities coming up this year and next. And as scary as that sounds, I would say a couple of things. First of all, the underwriting standards this time around on commercial real estate loans have actually been a lot tighter and a lot better. So if during the financial crisis, the loan-to-value ratio was about 70%, recent loans have been underwritten at 52%, 56%. So that means that commercial real estate can decline by a whole lot more than 10 or 15%, which it did already before you eat through that equity buffer. So again, as scary as the wall of maturity sounds, I think there's some mitigating factors. But obviously, we do worry about things like office, where the vacancy rate is between 12 or 16%, depending on where you look. So I do suspect we'll see defaults there. But again, Lisa, commercial real estate prices have already adjusted by 15%. In the case of office, they've adjusted by 25%. So I suspect over the next few months, in the next coming quarters, I think this is actually an opportunistic environment for investors.
Well, Anastasia, bullish when many others weren't. Thank you. Thank you. That trade's turned out from earlier this month. That's for sure. Anastasia Amoroso there of iCapital, Tom. Still looking to break out from that very tight trading range through 4,200.
And maybe bonds can be an equity bull signal. Lisa, to review this, LVMH, they did a $1 billion short-term paper offer out, I think, 2 years, 3 years. It was 2.7 times to 1 subscribed, and they were able to set the yield approximately 22 basis points, 0.22 percentage points below where they thought they'd have to be. That's a bull market.
Well,
that's stunning.
Well, as John was talking about, this is a very specific issue or two that hadn't come to market since the height of the pandemic in March 2020, and that was for an acquisition. But to the point that Anastasia is making, there still is plenty of demand, and perhaps fear of missing out on the part of buyers seems to be coming back to the fore.
That's an LVMH bull market. Let's be super clear about that.
It may be, but there's other companies out there. They got to go to the truck
like
and load the boat on debt.
Yeah.
I mean, there's no question about it.
Just have to describe another luxury player.
Exactly.
Like LVMH.
Exactly.
I mean, Anastasia's got she's got tons of Louis Vuitton.
You speaking for yourself?
No, I know Anastasia. She's got, it's Louis Vuitton. That's what they want.
Is that how you pronounce it?
Yeah.
Okay.
Yeah.
James Athey coming up.
After the whole bank stress earlier this year, for me, recession odds increase and hard recession odds increase along with that.
If your economy is not in recession now, and it hasn't been in recession recently, it's got a 20% chance that it's going to have a recession in the next year.
The bond market's been pricing in recession for a long time now.
Everyone says this is going to be a shallow recession, and I find that statement to be more a function of comfort than analysis.
There is so much negative emotion in the market right now that really the only surprise it would be to the upside.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television. Crisis over. It's back to watching the Fed. John, the headlines here with all the big banks reporting and some of the selected regionals coming in is the Silicon Valley to the rest of banking America thing was a bit overplayed.
The good news is it's not terrible so far, but I keep going back. I might sound like a broken record, but I think this is important. There are two ways of viewing this. One, it was a one-off event. We can leave it in the past. Two, it was the start of a process that will lead to tighter financial conditions, tighter lending standards, and softer growth, and ultimately maybe fewer rate hikes to the Federal Reserve. I can tell you we're taking out some of those rate cuts that have been priced in over the last month. Citi's Andrew Hollenhorst has been so consistent about this over the last month. His view has not changed. He says this: a May 3rd 25 basis point hike is close to fully priced, and the market is beginning to afford more probability of another hike in June as well. Their base case and what they expect: 25 in May, 25 in June, 25 in July, and at the end of it all, Tom, a rate that is closer to 6 than it is to 5 by year end.
Dovetailing with that with strategy, moments ago, Ira Jersey, expert on the short-term paper market with Bloomberg Intelligence. John, I'll read the headline. Bond bulls, that's price up, yield down. Better brace for a bumpy road ahead.
And we're seeing that this morning. Yields up, Lisa, by 7 basis points. The 2-year very close to 430 after breaking down towards the 350 kind of level over the last month or so.
Have stocks priced that in? Have stocks repriced the idea of a Fed risk back on the table? And I think that's one key question, especially as you see the NASDAQ once again underperform in the face of higher yields. But going forward, when is this good enough to give the all clear to the picture that we saw pre-March 8th? Or are we looking at the slow grind? We saw loan loss provisions increase. We saw deposits fall on the margins around a number of banks. Investment banking, lethargic going forward. These all are going to constrain things going forward.
Or are we back to studying inflation? How boring, how quaint. You look at the United Kingdom today, we haven't made enough about it.
Double digits.
Wow, those are sobering statistics.
Still north of 10. Look at Europe, still sticky.
Yeah.
The rate hike effort returns. There was a belief, Tom, I think that Governor Bailey may back away from rate hikes at the Bank of England, but after that data this morning, it's going to be tremendously difficult to make such a move.
Quote, he didn't want to declare victory, unquote, and he looks good in hindsight on that. I would suggest the clear message at the IMF meetings was a 5 or 4% inflation rate is just absolutely unacceptable. I mean,
you described the IMF, Tom. You know what I witnessed at the IMF is just a bunch of people with their heads in the sand at the International Monetary Fund, just firmly in the sand, talking about pre-pandemic interest rates and these big 5-year views. After we've just seen,
that's part of their mandate.
After we've seen such a big development in the last month or so.
Is it head in the sand or head firmly in diplomacy and in certain kinds of politicking?
Probably that too, sure.
Well, because, I mean, I think about it, they had these sort of range of possible outcomes that could be very different from going back to those pre-pandemic norms. It's just that they were kind of subjugated down lower because it doesn't really matter. But you're right. I mean, there is this sort of feeling that the world has moved on and perhaps policymakers haven't caught up.
Pressure on Europe, the Eurozone, the ECB, the UK, the Bank of England, Tom, to do more.
Within the bull market that Anastasia and Moroso talked about, John, to get the data moving here, the VIX 17.51. The angst today feels like a VIX of 19 or 20. It's not where we are. Within a bull market, we're under 18.
Equities at the moment down about 0.6% on the S&P 500. If you are just tuning in, welcome to the programme. Morgan Stanley out a little bit earlier. Some disappointment around certain issues, but on the big issues for this bank, wealth management, doing okay, FIC trading, doing okay. The stock just negative in the pre-market. Alongside what's happening in the equity market, down 0.6% on the S&P. There's that bond move for you. We talked about the front end of the curve. Yields up, Likewise, on the long end, on a 10-year, up 4 basis points, 361.57. And we're seeing off the back of that some dollar strength, Tom. Euro dollar down 1/3 of 1%, 109.32.
We're going to watch it carefully for the pros. I'm looking at euro yen as a real global metric here. We have not broken out the strong euro weak yen. That will wait. Joining us now to piece this together is someone widely followed worldwide. He is with Aberdeen. James Athey joins us, their investment director. James, what are you going to write about this week? I mean, we've discovered here it's Wednesday. We got to get to Friday. What is the theme for you in your writing, given the immense jumble of the moment we're in?
Hey, Tom. Well, that, to be honest, is the theme. that is exactly how I would think about what we're seeing in front of us, is that the signal you're getting from looking at equity markets, looking at bond markets, it is very much jarring. It's very much a confused macro picture where bonds are probably priced for somewhere between bimodal outcomes in a world where both of those bimodal outcomes are bad for risk assets, because one is much higher rates, much more persistent inflation, and the other is much lower growth, and equities aren't priced for either of those two outcomes. So I think we're just continuing to see the fact that markets are not making sense when you look at the signals they're sending cross asset. And to be honest, a lot of that, one of the clips that you played earlier was about the fact that sentiment is so weak that the only way is up. And if you look at things like the Bank of America Fund Manager Survey, you can draw the same conclusion. But I think we learned something about market structure and the extent to which a lot of investment decisions are not made based on fundamentals, but based on price triggers and vol triggers. And that's where a lot of this equity buying has come from.
James, every single day we're reassessing the probability of this banking shock turning into something worse in the economy. And we've really priced out those rate cuts more recently. If you take the 2-year, the pre-SVB high and the post-SVB low, the 2-year yield is somewhere right in the middle of that right now. The high north of 5%, the low close to 350. Right now, let's call it 420 something, James. So now comes the big call. Which direction do you want to lean in, James? To higher yields or lower ones again?
No, it's certainly lower, John. I think, we did overshoot because, of course, at the time of banks, going bust, essentially, the global financial crisis fears all come flooding back. And we wonder to what extent there's going to be a sort of domino rally of collapses. The reality was that there's a common trigger, which is obviously liquidity withdrawal, but there were specific vulnerabilities in those bank business models. But the Fed has already told us that tightening lending standards, in their opinion, will substitute for rate hikes. They don't quite know how many, but their best guess looks to be a couple, because those 2-year yield highs that you refer to above 5% came hot on the heels of Jerome Powell suggesting they may go back to hiking by 50 basis points. And where we were priced in the strip then versus where we're priced now suggests that it's very difficult for us to go back to thinking about 50 basis point hikes, a much higher terminal rate, until we have sufficient evidence telling us that bank lending standards are not going to tighten enough to substitute for those rate hikes. And that's obviously going to take time. And in that time, the current path of economic data suggests things will continue to slow.
How vulnerable does this make big tech?
I mean, big tech is infallible, isn't it? I keep hearing that the wonderful pseudoscientific analysis that goes on with big tech, whereby a strong economy is good for big tech because it's equities, and a weak economy is good for big tech because it's a duration proxy. It tends to be the case that those sort of pseudoscientific hypotheses will get falsified at some stage, and stocks that we believed to be acyclical or counter-cyclical will turn out to be much more cyclical. But that there's a certain element of a leap of faith or a fear of missing out, I think, when it comes to big tech. Ultimately, a recession is the test for all stocks, and I can't imagine that big tech will necessarily rally from these sort of valuations if indeed we do go into recession.
Forgive me for sounding a bit exhausted with the way that markets have been trading over the past couple of weeks, but I'm wondering how long you think we're going to remain in this churn where there really isn't a clear direction or narrative dominating anything, and really people have to do the work and go to the specific names and understand the companies and go back to an old-fashioned form of investing.
Yeah, I mean, I share your weariness, Lisa, to be honest. Again, a lot of that does relate to the fact that we'd had a very, very violent move. 2-year yield went from nearly 510 to nearly 350 in the space of a few trading sessions. And that was really pricing Fed cuts as soon as June or July. And that always, even for somebody who's been pretty bearish on the outlook for as long as I have, that always felt like an overshoot in the very short term. So just unwinding that is the kind of moves that we're seeing currently. It's a bigger test from this point on. We've just had a quiet data week, but of course, as we move through this month into next, we'll start to see more significant economic data points testing the market's resolve from all angles.
This year's been amazing. James earlier this year called it narrative table tennis, just back and forth from one thing to another. I keep going over that.
Yeah.
You know, January it was soft landing, February it was no landing, March it was hard landing, and April is like something in between.
All priced in.
Still trying to work it out. James, final question for you. Who have you got more faith in, the Federal Reserve or Spurs?
Right now, the Fed. If you'd have asked me the Bank of England or Spurs, that would have been a really, really difficult decision. As a long-suffering Spurs fan, you learn never to have faith in Spurs.
James, the Bournemouth Cherries tore them apart. What do you do when you got this gorgeous stadium? Help me here, John. Adele loves you. Emma loves you. I mean, everybody loves the Tots. And they're like the Toronto Maple Leafs. They're like built not to win.
And just not getting it done. Just
for like, what, 20 years?
For a long time. James, what is it? Antonio Conte, the manager, complained about the culture of that football club. What is it?
Yeah, I mean, it does look like there's a psychological block, even when we had Maurizio Pochettino and we were all conquering. I used to go to games, and it didn't matter who we were playing, home or away. I walk in thinking we're going to win when we had Pochettino as manager. And over the course of 2 seasons, we had more points, scored more goals, conceded less goals than anyone else in the league, and we managed to lose the league on both of those occasions. So it does feel like there's a psychological block at the club. But we need a new manager. That would be a good start.
Today, Bayern Munich, Manchester City, are they lobbying for Harry Kane? I mean, when does Harry Kane just say enough?
I think we might be close to that.
I'm serious.
This summer transfer window is important because he's getting to a certain age where you've got to make the call for your next 3 to 5 year contract.
I think this needs team coverage by Bloomberg Surveillance.
I think this is the extent of our team coverage. If Lisa is responsible, that was it. And it kind of went about 2 minutes over, didn't it? I can see him at the corner of my eye.
She's doing her taxes. She filed for an extension. She's doing her taxes over there.
Do you think Lisa's the kind of person who files for extensions? Bramo's not an extension kind of woman. No, that doesn't surprise me. Futures down about 0.6 on the S&P. Matt Lazzetti at Deutsche Bank coming up shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Republicans will vote next week on a bill to raise a debt limit and impose new cuts to government spending. President Biden and other Democratic leaders are refusing to offer any concessions. Republicans are betting that if the House passes the bill, that can ramp up pressure on Democrats to consider compromises. The debt ceiling has to be raised or the U.S. runs a risk of a default. Another strong inflation reading is raising the likelihood for more interest rate hikes at the Bank of England. Britain's Consumer Prices Index rose 10.1% in March from a year ago, driven by the strongest increase in food prices in more than 4 decades. The pound edged higher, and UK government bonds sank after that report. Fox News has avoided a potentially embarrassing trial. The network agreed to pay $787.5 million to settle a voting machine maker's defamation lawsuit over its 2020 election broadcasts. The settlement was for less than half what Dominion had asked for, but was far above analyst estimates. Fox had aired bogus claims that Dominion rigged the vote against Donald Trump. Baker Hughes is forecasting decades of growth for natural gas demand. The world's 3rd largest oil field services provider posted the strongest first quarter sales since 2019. Baker Hughes says the world is seeing the crucial role that natural gas will have in the energy transition. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
It's almost like people are determined to spend and spend on travel in particular. Even we're seeing our fares. Last year we saw fares rise by 14-15%. We think this summer, and I'm on record as saying, I think it'll be we might get to double digit again, maybe 10% increase in airfares.
Here we go again. That was Michael O'Leary, the Ryanair CEO, the European airline. Double-digit fare increases last year, maybe the same again this summer. I know we all can't wait, can we, TK?
Did he make a recession call? I don't think he did.
I didn't hear anything.
I did not hear that. He was like on the edge of James Bullard.
Boom time in Europe. He was talking about the invasion of American tourists onto European shores, Bramo.
I loved
it. It was getting busy.
It was like kind of really nice, and it was also kind
At the
of
same time,
like,
it was an insult.
yeah, it was like, really? You guys are just basically an infestation.
Can we just hand him Newark Airport and see what he would
and ask
do
him
with
to
it?
Figure it out.
Figure it out. I mean,
LaGuardia is looking good, I have to say. Every time I get there,
this is
every
the future.
time I get there, I arrive and get to that terminal, see that beautiful view.
It's
Queens
on the edge of Zurich.
Manhattan. Just frame it. It's beautiful. Love that. Love it.
This city's fallen
Say
apart
that
with
for yourself.
infrastructure projects, including a tragic parking garage collapse yesterday. And LaGuardia is a symbol, John, of the future. That's the only way they're going to get it done.
Make it happen. JFK is just depressing.
Well,
JFK. Then you leave from Heathrow and you're just like, whoa. What happened here?
Yeah, or name 10 other airports in Europe. I mean, Edinburgh.
Pick any international airport you like.
Yeah,
it just doesn't add up. Anyway, tons of Fed speak a little bit later. I'm sure they'll talk about the airlines.
With John Ferro.
Goolsby and Williams on tap, talking about JFK, Newark, and LaGuardia. Matt Lazzelli at Deutsche Bank doubts we'll hear much of any of that. And he doubts we'll hear much to sway expectations either. Our own forecast continues to see the Fed holding steady at 5.1% through year-end before beginning to cut rates in January 2024. TK, that's the Lazzetti Deutsche Bank call. I have to say, not much daylight between that and a lot of what's been priced recently.
Yeah, I think what's interesting here is to frame it around the debate that's out there. And we've heard it this morning, even, of sustained inflation like what's in the United Kingdom, all the way down to real talk about substantial disinflation, including goods deflation. Matthew Lazzetti joins us now with Deutsche Bank. And away from your arch recession call, you led on that among, I think, all of market economics. Your call for interest rates is like Richard Claird, as the former vice chair, writing in The Economist. No, we're not going to get back to 2%, not back to 1%. But what does our world look like with an inflation that gets back to 2.6, 3.2, that kind of level, the Claird level?
Yeah, so I think that's closer to where we expect to be by the end of this year. We have core PC around 3.5%. That is a lot of progress from where we are today. I would agree with Governor Waller's comments recently that over the past year, you've basically seen very little progress, and we can point to different components that have moved back and forth. But the reality is we haven't seen much progress over the past year. I think getting back down to 3.5% for the Fed, that matters in the context of what the labor market looks like. So if you still have a 4% or below unemployment rate, you have a Fed where the Fed funds rate is probably higher, certainly not as cutting rates. But if that's occurring within the context of a recession where the unemployment rate has risen to 4.5% or 5%, which is the context that we expect, that'll be what triggers the Fed to be cutting rates.
And then to add that into your GDP call, do you have a diminished inflation, a disinflation, into a slowing real GDP level or quarter-to-quarter movement that gets us down to a new diminished nominal GDP?
We do. We have modestly positive growth in Q3. We have negative growth beginning in Q4 into the first half of next year.
Sub 4% nominal GDP?
It is.
Wow.
When you add in where inflation is, we only have 0.6% growth for this year. So it is sub 4% nominal GDP. But I think really for the Fed, it's the context of what is happening with the labor market. I think that's been the key area of debate. We've seen it slowing there, but I think across most of the metrics, still 4 million more job openings than unemployed individuals. The private quits rate actually ticked up recently. The Atlanta Fed wage growth tracker hasn't shown any progress in coming down. I think that's really the crux for the Fed.
A lot of people lean on the projections coming from the Federal Reserve, the quarterly SCP, the summary of economic projections. There's not much daylight between your rates call and their rates call for this year. In fact, there's no daylight at all. Where is there some daylight between you and the Federal Reserve when you look at their outlook?
Yeah, I would note, I think they've come a little bit closer to us over time.
Yeah, I would say that too.
But at the moment, there is, for this year, very little daylight. There is greater daylight into 2024, and they have their path, which I think is this gradual cutting path, under something that looks somewhat like a soft landing, even with the unemployment rate rising by 1 percentage point. And they're just kind of gliding back towards neutral. Our expectation is that they have to cut more aggressively, that you get a recession, the unemployment rate rises. We have 225 basis points of cuts between Q1 and Q3 of next year. There is, no doubt, a gap between us and where the Fed is and the market at the moment by the end of the year. But that gap's been diminished. We're at a 4.6% or so Fed funds rate at the end of this year. And that seems quite reasonable to me within the context of, you might have a recession beginning in Q4.
Can you dovetail that idea of more aggressive rate cuts in 2024 with what we've heard from the banks just now, which was supposed to be really telling from an economic perspective? We would finally know how bad this credit crunch or credit kerfuffle or whatever you want to call it was. Now we're living in this sort of like, what did we learn? We're not sure. I mean, how much have you learned from this?
Yeah, I think not much yet. We're hearing from a lot of the larger banks, which were anticipated to be a beneficiary of some of the stress in the smaller and medium-sized banks. In terms of the Fed's H4 and H8 data, we've seen decreasing stress in the Fed's balance sheet, which I think has been a positive. It's giving us some sense that we're hopefully beyond the acute phase of what's been happening in the banking sector. But I think everybody's anticipating that we're still going to have this tightening of lending conditions, tightening of credit conditions that takes place that reduces growth. That is part of our baseline expectation. But at the moment, it's mostly scenario analysis. We really can't have a great idea of how much things are going to tighten. We'll get the Fed Senior Loan Officer survey in early May. I expect that's going to be quite negative, just given when that was occurring, kind of around the peak stress that we were seeing.
Going back to 2024 and your belief that the Fed's going to cut much more aggressively, what's the threshold? What's the bar going to be for them to be more aggressive with rate cuts?
Yeah, I think it's, are we seeing a recession take place? Their forecast for the unemployment rate is that it rises up to 4.6% and stays there. You don't ever really see that in a recession. These things are nonlinear. If it rises 50 basis points, you get a recession, it rises by at least 2 percentage points. And so I think if you have something that looks more like a typical recession, which is basically our forecast, you get a 2 percentage point rise in the unemployment rate, then I think we should expect that they will be cutting rates. I think they've been very clear they're not going to repeat the mistakes of the 1970s. The way that I would kind of view the mistakes of the 1970s were that they cut the real rate from very positive territory to very negative real territory very quickly. We don't expect them to do that this time around. They can cut rates pretty materially and still have a positive real Fed funds rate.
It's so unfair of me to ask this, but is that forecast a political forecast? Do you think there's a political element to it? To say 4.5 year end, 4.646 next 2 years. How much, I'll phrase it differently because I know you don't want to answer this. How much political heat would they get if they were forecasting anything higher than 4.5% and described exactly what you think is going to play out?
Yeah, I don't know if it's as much politics as there's a confidence channel from how the Fed is forecasting things. And so they have a different role to play than I do. They can impact sentiment in the economy. They can impact, I think, overall confidence, and therefore can impact what the actual outcome for the economy is. And so I think, that should be viewed within that. Both their inflation forecast, but also what they're showing with the unemployment rate. It's notable, I think, nonetheless, that they're showing the unemployment rising as much as it has. It's notable that in the minutes, the Fed staff, very clearly has a baseline mild recession. These things don't happen very often from the Fed's perspective. So I think it is a commitment in showing that they are willing to take the necessary actions to get inflation down.
But Tom, it's almost Soros Popper-esque that you can shape the events you anticipate. It's almost something self-fulfilling about unemployment forecasts at the Federal Reserve.
One of the best conversations I ever had was with the younger George Soros talking about Karl Popper in the early 1950s at LSE. This is economic epistemology, religion, I say, at UCLA. And the idea is you get out front and then can you reframe things as you go along? That's the narrative's reframing, if you will.
Hey, Matt, this was smart. Always is. Matt Mazzetti there of Deutsche Bank.
I never thought we'd get there.
On a forecast.
Here we are.
At the Federal Reserve. Matt, thank you. In the next hour on Bloomberg TV, on the bond market, Subhadra Jabra of SocGen, Gershon Distenfeld of AllianceBernstein, on banks, Ken Leon of CFRA, and on everything, Jay Pawlowski of TPW Advisory. Jay's been super constructive on the financials. Even through the mess in March, Tom, he's stuck with it.
Ask him about the Pacific Rim. He was way out front on China optimism.
And remains super constructive, Tom, across the board, worldwide. In fact, sees the rest of the world outperforming in a major way from a market's perspective. We'll talk about that. Futures on the S&P 500 this morning, -5 or 0.6%. Yields pushing higher by 5 basis points on a 10-year 362. On a 2-year yield, higher by 6 basis points. Very close to 430 a little bit earlier this morning. Your 2-year, 425.
Bloomberg Surveillance. Good morning, everyone. Within banking season, the major banks out here, Morgan Stanley earlier, we're looking at some of the smaller banks moving into today and also into the coming days as well. Lisa Abramowicz and Tom Keene. John Farrell getting ready for a really interesting 9 a.m. Effort here. Within a day where the data is a little nudgier than it's been the last number of days. I note the VIX 17.36, futures negative 24. That's 0.6% down for SPX. Lisa, we haven't even talked about it. Second day, I think, in 3, where Bitcoin just loses the bid. I don't know what to make of it. I mean, I'm going to wait for crypto 5 days from now.
I'll let you do the Bitcoin analysis.
29,000.
I am curious about some of the earnings that we've gotten, and we've talked about some of the banks, Morgan Stanley among them, as well as some of the regional Citizens Financial, as well as U.S. Bancorp. But Ally Financial came out this morning, little talked about.
Yeah, thank you.
This, to me, was quite interesting because this is the auto lending sector, and this is a question of the consumer credit impulse and whether there's any contraction. And there was. You saw actually fewer loan originations in the auto space than people were previously expecting. You have a sense that they are tightening their underwriting standards, with some consumers walking into dealerships, and listen to this anecdote, with $10,000 in negative equity, and others who are struggling to make payments on existing loans. This goes to the heart of auto pricing. This goes to the heart of whether people will continue to spend what they don't have if this kind of credit is being constrained.
I'm so glad you bring this up, but of course, this is the ex-GM finance wing, renamed Ally, A-L-L-Y, for those of you internationally. And what this goes back to is Olivier Blanchard talking about the Biden stimulus. And on the back end of that COVID stimulus, what did we do? Went out and bought a car.
Well, exactly.
That's what a lot of America did.
So perhaps people aren't running out of cash to buy airplane tickets, but are they running out of cash to buy new cars? Are they running out of cash for some of the bigger industrial goods?
And to maintain new cars.
Which is the reason why perhaps you've seen this bifurcation between services, still hot, and the industrial goods, which have seen a recession.
And to dovetail into this is a good conversation. We've had a number of them today, different views, but in the heart of it is Michelle Girard, head of U.S. Markets at NatWest Markets, I should say. And Michelle, I love your note because you're very consumer-based, 70% of the economy. Lisa outlines some of these tensions are there. Is this the point where the consumer finally gives up the Biden stimulus and the boom?
Yeah, I think so much of what you were just talking about is where our concern lies. And it is around the potential for a credit crunch to really put a restraint on the consumer that we haven't seen. You know, as you said, since the crisis, the consumer was flush with cash. Then they had very high savings, and they've really been able to extend their spending long beyond, I think, what people had expected. The shock of sharply higher interest rates not really seeming to put much a dent in demand. But I think when you now combine that with the credit crunch and Lisa, as you pointed out, looking in the results that we're getting to try to see to what extent there is some bite in that. We're looking at the senior loan officer rate to see how much credit conditions are tightening. I mean, all of that we think will come together to put some real pressure on the consumer in a way that we haven't, and tip the economy into a recession later this year.
Miles away, folks, May 5th. Lisa, I don't think this is a good number yet. Change in non-farm payrolls, a survey is 175,000, which is below 200, below the convention we've seen during the COVID boom. And Michelle, what does that glide path do? I mean, David Kelly over at JP Morgan talks about a negative non-farm payroll statistic. Are we going to see that this year?
That would be our forecast. We've got negative GDP growth in the second half of the year, a recession. And so, of course, alongside that, we'd expect to see negative payroll prints. We've got the unemployment rate rising a bit, like over a percentage point, getting to over 4.5 by the end of the year. So we do expect that you will see the strength of the labor market taper as the overall economy really begins to slow. And it really comes back to the impact really of the tightening in financial conditions, particularly now exacerbated by credit standards being tightened and the bite that will have on both businesses and the consumer. And in general, I think just more caution and optimism, particularly on the part of business now, given given the environment is I think much more uncertain going forward.
Michelle, how do you push back against people who say with the auto sector, there's a lot of specific details that are, I don't want to use the I word, but let's use it, idiosyncratic to the auto sector, that you're seeing sort of a tightening after an incredible loosening there, and you're not seeing the same kind of pressures in the services sectors and some of the other spending facing kinds of areas. How do you push back and say it all will suffer heading into the end of the year as we see some of these tighter credit conditions bleed through?
Well, and that's exactly the point. I mean, autos may have some idiosyncratic issues, but autos and other kind of cyclical spending areas tend to be the early warning signs. That's where trouble seems to first present itself, and very well may be the first area that we see issues now. And it is our expectation, particularly as we think about the economy worsening, businesses getting more cautious, hiring and labor demand, beginning to wane. All of that will feed through into a broadening out of the weaker spending patterns that are now evident in just some specific areas. And so, that is the point. Is that yes, at the moment it looks fairly narrowly focused, but that's often how these things start, and then they broaden out. And the trends that we're seeing, as I said, some of the leading indicators about where business spending and activity and so forth are going that precede broader demand changes, that's the stuff that we're watching and signals to us some much more headwinds ahead.
Will those headwinds be enough to bring inflation to where the Fed wants?
Yeah, I mean, that's been, we've been really skeptical about inflation being able to get back to 2%. But now I think with even more confidence that the economy is going to, be weaker because of these headwinds, I think we do feel that the odds of the inflation rate, getting back to 2% without the Fed having to take rates as high as we had anticipated, we're more confident about that. We don't have inflation getting back to target until 2024, but we also have taken off some of the expectations for Fed rate hikes that we have. We think the Fed is done. I mean, may they go again in May? I guess right. Possibly. We're not dug in about that, but essentially we're sort of at the peak in rates, and we've actually got the Fed, cutting rates into 2024.
Well, Michelle, bring that over to the yield market, to where we actually price all this mumbo jumbo. There is a narrative that we're hearing, not from all, but from some, that yield comes in from here, 10-year yield comes in 3%, dare I say under 3% as well. I would suggest most of our audience on radio and television doesn't believe that. Are you setting us up for a 2.95% 10-year yield?
We don't have yields going quite that low that fast, in part because you do have inflation that is still going to remain sort of stubbornly high, and also in the sense that it won't really fall below. I think we've got it at the end of the year at 3%. It won't get towards target. It won't put the Fed in a position to be able to lower rates until later in the year. And I think that provides, I think it slows the speed at which you can actually see yields move dramatically lower. And so, that is the trend that we see. But I think the pace of all of that unfolding may take longer than some expect.
Michelle, it sounds like you're conservatively positioned, and I'm curious how painful it's been over the past couple of weeks as basically markets shrug off a lot of the gloom and doom and manage to rally.
It's, as we know in the economics, field, I mean, you've got a whole host of data that can tell a bunch of different stories. And the bottom line is that no one can really be confident, the Fed included, about exactly what the path will be, what other events may, get thrown in to alter expectations. And so, I mean, I think in general, I understand the resilience, because if we're talking about the Fed having to do less, if we're more open to inflation coming down closer to target with the Fed doing less, perhaps a stage set for, a path where the Fed can cut rates sooner. I understand that there's some relief that goes along with that can provide, some support. But when the data do start to, I think, more uniformly suggest that the economy is going to be in for, some struggles, then the question about market pricing and do market prices accurately reflect underlying economic fundamentals will be tested.
Michelle, thank you so much. Michelle Girard with us with NatWest Markets here this morning. Lisa, I think we've got to encapsulate some of these narratives. And there's one narrative that the Fed will raise rates and then they'll raise rates some more. And I guess that narrative is inflation's sticky, yields stay higher. We have a 7% mortgage rate. I'm trying to sum together the jumble. And they'll say that leads to a recession. And then the other narrative is completely opposite. We've heard this from our guests this morning. Rates come in, inflation comes in. I guess the mortgage rates come down, and the outcome's the same. We still have a recession. That's sort of what I'm hearing.
Well, the question is just what are we going back to in terms of the new real rate of inflation? And I think that that's really the question that a lot of people have, with Dan Greenhouse saying that the resilience we've seen in the economy suggests something higher than we've seen pre-pandemic, and with others, including the IMF, saying that we're going back there. I do want to give you just some color from the first quarter earnings call with Morgan Stanley, with James Gorman coming out and saying he doesn't believe we're in a credit crisis or banking crisis, but he does think that a few banks may be in trouble. He said this is nothing like 2008. It seems like the earnings have confirmed that. So then what is the analog to this moment? And I think that that's what people are struggling with and trying to read through what this means for credit formation in the United States. And that's the reason why I think Ally Financial is so interesting, because it hints at the others. It hints at the non-behemoths that can really have a lot more discretion with who they cater to people who have to actually restrain some of their credit extension because of what they're seeing in the delinquency rates and in the charge-offs. I
go to the BTMM screen to look at the challenges here with that Goldman Sachs Apple interest rate of 4.15%. I don't know what the different parts of Morgan Stanley's doing, but I'm looking at a 5.16% 3-month T-bill. I'm looking at LIBOR setting 5.26 today, which is right up buttressed against recent highs as well. And at some point, it's got to give. They've got to start paying more for deposits. And I wondered, can they make it to this weekend without doing that? And then it calms down.
Well, Morgan Stanley actually said that they did report fewer deposits than some expected. Although, in general, the stickiness of these deposits has been amazing.
Well, you give out a toaster, that's what you get. We're going to come back. We've got some really interesting things to talk about. Lisa Abramowicz and Tom Keene here. Futures negative 25. Dow futures negative 110. I did that for John Farrow. The VIX 17.35. On radio, on television, Bloomberg surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Fox News will pay $787.5 million to avoid what could have been an extremely embarrassing trial. Fox agreed to settle a defamation lawsuit by Dominion Voting Systems over the network's 2020 election broadcast. Dominion says Fox defamed it by airing claims it rigged the vote. Evidence showed that Fox executives and the stars derided the conspiracy theory, even as they promoted it. It's official. India is now the most populous nation in the world. According to the United Nations, India's population is now almost 1.43 billion, edging out China. The increase will put more pressure on India's Prime Minister, Narendra Modi's government, to create jobs. There's another sign that Tesla CEO Elon Musk is willing to sacrifice profits to boost demand. The electric car maker cut the price of its long-range Model Y SUV by more than 5% to just under $50,000. The cost of the Model 3 fell 4.7% to just under $40,000. Tesla reports first quarter earnings today. And mortgage rates in the U.S. rose last week by the most in 2 months. According to the Mortgage Bankers Association, the contract rate on a 30-year fixed loan rose 13 basis points to 6.43%. Meanwhile, the group's index of mortgage applications fell 10%. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We have to remember that, the Federal Reserve is implementing quantitative tightening with the intention of reducing deposits out of the banking system after they created over $3 trillion under QE. So the entire banking system is going to see their deposits shrink. And the real question is the mix of your deposits. And the regional banks and the big money center banks, as well as Morgan Stanley, have good core consumer deposits, which are critical.
Gerard Cassidy speaking earlier to Global Wall Street with RBC Capital Markets. John Ferro with Ken Leon here in the next hour. Must listen and watch for all of you of Global Wall Street. This really interesting moment for banking in America. I've got a deterioration in futures in the last number of minutes. Futures negative 25 to negative 28. And NASDAQ down now 0.9% as well. So a bit of a pullback after the festivities of the last number of days. What I learned in a panel late Friday at the International Monetary Fund meetings was that anybody with the IMF that mentioned China, don't mention China, probably would be shown the door at the IMF. It was the great unspoken word of the IMF meetings. Joining us now is our Assistant Deputy Managing Director of International Emerging Markets and saying the China word. How did President Trump say China? China. However he said, I can't do the imitation. Lisa's better at it than I am. Damian Sassower joins us. Let's start with a why. Why don't they want to mention China?
Well, it's not the economic reopening. It's really geopolitical uncertainty that goes hand in hand with the fact that the U.S. and China really just don't have a dialogue, really a working dialogue today. And I think that's been, an overriding concern for some time now. But it really reached an apex, I think, over the past week. And I think it's spread out into a number of different issues. The fact that China has a managed currency and what that's doing for central banks across the Southeast Asian complex. It's doing good things, by the way. But in the same breath, look at Taiwan and look where we are. And Taiwan, as Lisa and I were just talking about, Taiwan export orders tomorrow is such a big number for the tech sector, for global equities, for the Southeast Asian bloc, for quite frankly the globe writ large, because it's going to tell us the extent to which China can really grow through the second half of this year. We know it's going to grow fast through the first half, the second half, all bets are out.
Which Pacific Rim complex or country has seen price down, yield up, where you can take advantage of the stress?
Well, they've all seen yield up, but not nearly as much as other regions. Eastern Europe and LATAM, talk about yield up on a nominal basis. I looked at the Bolivia chart, Lisa. No, but just Brazil, Mexico. I'm talking the investable ones, Poland, Hungary. Their yields are, and certainly on a inflation-adjusted basis, Latin America looks a heck of a lot more attractive than Eastern Europe. But going back to Asia, because the yuan is a managed currency, the central banks haven't had to move as quickly. Their currencies, by them not hiking, their currencies haven't gotten beaten down versus the dollar nearly as bad as those other regions. And so they're at an inherent advantage and they can manage their economic growth a little bit better.
I want to sit on what we get from Taiwan tomorrow, especially given the fact that we get the Taiwan Semiconductor Manufacturing Company reporting earnings tomorrow as well. How indicative this is of a recovery that China is putting out there in the official numbers that isn't being borne out in international trade.
Right. So China on a quarterly basis is probably going to do 10% in the first quarter. Let's call it, another 6% in the second quarter, but then 3-4, we don't know. And a lot of that is predicated on the revival domestically and domestic consumption. For that growth to extend abroad and to extend through the full year, you need to see trade pick up. You need to see exports pick up. You need to see machinery orders. Semiconductor orders all pick up, and we just haven't seen evidence of that yet. South Korea, Japan, and now Taiwan. And Taiwan really is the apex of that, as you rightly point out, Lisa. Taiwan Semiconductor has a virtual monopoly on semiconductors, and so we really need to see a turnaround there for us to get, I guess, any sort of bullish, risk-on sentiment with regard to the high beta asset classes like commodities and equities.
When you come in the morning, that's where I was going to go. How closely do you watch, for example, the response in the commodity complex to the numbers that we got out of China? People saying, look, the numbers beat. They're going to do great. You're going to see an upgrade to the potential full-year GDP. And then commodities fell out of bed.
Yeah.
How does this make sense?
Well, I'll tell you, forget about what it is. Let's talk about what it means. What it means for emerging markets is something quite different than what it means for us here in the U.S. because food and energy are such a bigger component of inflation in these economies that by that being held lower because commodities are coming off, it's actually giving them the ability to perhaps cut rates that much more quickly when and if the Fed actually pauses, right. Certainly more than the developed market complex. And I expect that to happen probably in Latin America first.
I have a chart of Argentina, which I can truly say is an absolutely original chart. I was talking to some of the leaders of the IMF of it. Dollar peso, and then overlaid on it, and this is on a log y-axis, the percent change of the black market blue dollar peso.
Yep.
And the statement is, we've never been here. The IMF has put $1 kajillion into Argentina.
44 billion, yeah.
It's like a tuition payment to the University of Miami. It's that big.
Yeah.
And the answer here that you know about, and the answer here is, when do we say enough to Argentina?
We can't. I mean, the IMF
What do you mean by
its
that?
balance sheet is really locked into what they've done with Argentina. And even when Guzman left and Gidegopinath is now working at the IMF, is now working very closely, there's an election coming up. There's a lot of uncertainty there. But you're right. The blue chips, the parallel rate, as they call it, in Argentina, since Fernandez and the new regimes come in, it's traded about double that of the official dollar peso rate. And that really hasn't changed. So I think we're trading at 460, something crazy relative to 200 on the official rate. You just can't really invest in that country. It's funny. I was having this conversation yesterday. Somebody was down in Miami, actually. The Argentine diaspora is huge in Miami. And they all come up during the winter months. They get their dollars, they work, they do what they have to do, and then they all go back in the summer months and spend their dollars. So it's actually quite interesting. Look, Argentina's muddling by. The elections are front and center in October. That's going to be the next point for us to determine just what we're going to do with this $44 billion that keeps getting restructured.
We're talking about emerging markets around the world with Damian Sassower, and the reason why a lot of people are paying such close attention is because so many people have been saying this is the area that's going to outperform the U.S. Yes. It's going to outperform the developed markets in the year ahead, even though we could see some sort of downturn. Do you think that the facts edify that view?
Well, I think you have to talk about what part of the emerging market complex, and certainly I think what you're talking about is rates and FX, because EM credit's going to follow corporate credit in the U.S., and I think there's spread risk there. EM equities, it's not even talked about. So we're talking rates and FX, and if we're talking rates and FX, as I pointed out, when the Fed pauses, all of the rest of the world is going to rush to price and cuts in Brazil and Hungary and all these guys who are first movers, et cetera. So from a rates perspective, you're going to get that duration gain if it's not already been priced in. But the FX, the dollar story, is front and center. And look, I have long been one to never bet against King Dollar. But, what we're seeing, at least in the price action here, is, there might be some more runway for dollar weakness. And you see a lot of these currencies, specifically the Mexican peso, some of those who are maybe a little bit closer to, to the dollar, really decoupling from it, right? And so it's going to be interesting to see just how long this dollar weakness can hold up.
Peso, folks, 4 or 5 years ago was 21, 22. Yeah. Strong peso through 18, and yet we frame Mexico's terrible. How do you get a strong peso if we have this generalized statement, Mexico's terrible?
Yeah, well, look, here's what's interesting, and I had this conversation with, a mutual friend of ours yesterday, Tom. Emerging markets, the name emerging markets, how can we call many of these markets, like, for example, Brazil, emerging when their per capita GDP hasn't budged in 10, 12 years?
That's the heart of the matter, isn't it?
So, when you think of Mexico, Mexico's more North America. It's not emerging market, and you think of, if you want to tell me which markets have really emerged in the last decade, South Korea definitely, Poland, of course.
Right.
Now.
Well, it was wonderful speaking with the governor of the Bank of South Korea at the IMF meetings. But this is really important insight for Mr. Sassower, folks. This idea of EM is not homogenous; that there's shades of it, including those successful. Damian Sassower with us with Bloomberg Intelligence, just brilliant there. It's spanning the globe with Damian Sassower.
Well, it's linking in the trade data that we get to this idea of what we're seeing in some of these other markets, and this idea that if you don't get a commodity boom from a China reopening, well, that suddenly gives a green light to rate cuts in these other markets. It kind of shows the interconnectedness.
We're going to move on here with a nice summary of the day, but I want to first apologize to everyone. Somebody said, are you okay? And I said, well, I came in. As you know, Lisa, everyone has this plague in this cold spring that we have. And I've got my transfusion. I've got an IV of Tang. And, things are going, I'm going to just go home and go to bed. And hopefully it'll be better tomorrow. That's what we're all doing.
I hope you feel better, Tom.
It's just like, it's I got it and other people in the team have it. And we're just, we're fighting our way through it. Lisa, what's your thought here today as we wait for other bank earnings?
That we're not learning that much from bank earnings. And as frankly, other than we haven't really seen a massive crisis emerge, what I am curious about is when we start to shift focus to the other earnings that come out. Taiwan Semiconductor Manufacturing Company, for example, which we were just talking about with Damian, what we get in terms of the ongoing demand for some of these items that that really have fallen off in the past few quarters.
What I'm looking at, Bloomberg Financial Conditions Index, a really good series used by the IMF. It shows accommodation 0.30 standard deviations. All you need to know is that means May 3rd, Jerome Powell will get to work. Futures negative 26. Stay with us on radio, on television. This is Bloomberg Surveillance.